that a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Did you enjoy the weekend? It's like we never left. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene is away this week. Equity futures just about unchanged on the S&P 500. UBS, after securing a deal with Credit Suisse for 3 billion Swiss. Lisa, that stock is down by 8% in Swiss trading.
You asked yesterday, would this be enough? Would this be enough to shore up confidence in European banks? Would this be enough to shore up confidence just more broadly that officials have whatever is going on in the banking system contained? And it seems like the preliminary answer is no, not yet, at least in terms of risk aversion.
The other thing I asked yesterday is whether we'd found a solution or created a monster. Have we created a monster?
Well, again, is this a question of the monster of risk aversion? What do the regulators know that we don't in terms of why they're taking such bold action so quickly? Or is this the monster of moral hazard, of questions around what instruments actually do? I'm talking about the contingent convertible bonds that have been wiped out of the Credit Suisse deal, but also this question of the bailout mechanism of a lot of federal officials that had previously said that would never happen again.
Let me give you two takes. This from KBW. They've cut UBS and they say this. Considerable uncertainty around the earnings trajectory. That's one take. Here's the more constructive view. Comes from the team at Bank of America. They say the logic of the deal is, quote, impeccable, and the cost synergies, Lisa, could be, quote, substantial. That's the constructive view of this UBS Credit Suisse tie-up.
A lot of people are saying that this is going to be a very positive thing and it's a good deal for UBS, especially given that they've got a backstop, they've gotten liquidity lines, they've gotten a whole number of guarantees from the Swiss government. That said, there is a question about UBS's reliable stream of income in the way that they previously had. What do you do when you bring in an unknown and then try to integrate it over 3 to 4 years?
There's so much we don't know about this tie-up and about this situation currently. Here's a flavour of the price action for you. In the equity market on the S&P 500, equity futures on the S&P just slightly negative, down about 0.2%. In the bond market, we have been saying for about a week now that this market is screaming, you're done, to the Federal Reserve. The two-year yield, Lisa, down another 10 basis points. Your yield this morning, 373.
So I'm going to do a different kind of look ahead this morning as really front focus. The only thing that we're looking at, central bankers' response to what's going on in the markets and what's going on to risk appetite, as well as what's going on with the banking sector. At 10 a.m., ECB President Christine Lagarde can speak to both of those issues. She's speaking before the EP Committee on Economic and Monetary Affairs. What does she say now? Did she feel confident about her decision to raise rates by 50 basis points last week? Is she coming in with some alternative measures to try to shore up confidence in the banking system? We'll also get a view from a host of amazing guests this morning. We really have an incredible lineup. Bruce Kasman of JP Morgan, chief economist there. Bill Dudley, former head of the New York Fed. Michael Arrighetti, co-founder, chief executive officer, and president of Ares Management. And Leon Cooperman of Omega Advisors, weighing in on how they see this shaking out, credit conditions tightening, the read-through to the markets. And this, of course, sets the stage. You mentioned the Fed. What does Jay Powell do Tuesday and Wednesday? The meeting, Wednesday, the rate decision. Right now, the market is saying, as you said, you're done. You're seeing right now the question, not do they raise rates, but do they cut rates, and how quickly?
They've got to put out some forecasts.
Do they?
Good luck to them.
Yeah.
Well, they can take the playbook, a leaf out of the playbook back in the pandemic and not publish them at all. Or they can get a jug of freezing cold water and just pour it all over them and say, we've got no idea. The ECB has basically put out some forecasts as well in the last week, and everyone's running around saying the following. You'll hear this a lot. If the baseline holds, we might have to do more. But if the baseline holds, it's a pretty big if, isn't it?
Did anyone even look at the ECB's projections or take them seriously?
No.
Exactly.
I don't even remember them.
Exactly. And I think what the Fed could do is just hold them where they are, and then everybody ignores them, and then they carry on without making a statement one way or another on that front.
One name to watch as well, First Republic in the pre-market. So 11 US banks last week come together, deposit $30 billion into this institution. Friday at the close, down more than 30%. This morning, Lisa, down another 15 in pre-market trading.
And this comes after S&P downgraded them yet again because of the concern about flight of depositors. Again, you asked this question yesterday. What will it take to shore up confidence in regional banks? Right now, we haven't seen it.
Not much confidence there. The lead story over the weekend, as I'm sure by now you know, is Credit Suisse and UBS, a tie-up worth 3 billion Swiss francs. UBS buying its long-time rival. On top of the story, Bloomberg's Francine Lacqua in Zurich. Francine, so many questions still. What stands out for you?
Hi, John. So I think what stands out is actually we need to try and figure out. We know that the AT1 wipeout is going to cause ripple effects across the board, but that will also be used for equity for UBS. So given the credit lines, given the loans, and actually given the fresh capital that they have in terms of the AT1s, is that enough for UBS as a bank, the biggest bank in Switzerland, if this goes through, to deal with anything that they find within Credit Suisse? Now, we have been told, of course, that it's the investment bank that could be problematic. A lot of the bookings in terms of if there's anything toxic, or even if there's not toxins, the unwinding of some of the COCOs that Credit Suisse has, especially in London, will be, costly and could be time-consuming, especially in the market turmoil. So, first of all, is UBS strong enough to withstand? And then we just look at market share price reaction and bond reaction on the back of that AT1 wipeout. We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
Francine, how much pushback has there been about the fact that certain equity investors received something, even though these particular bondholders got wiped out?
Well, this is really what we're trying to get to the bottom of. Now, I asked yesterday, I had 7 of the most powerful people in Switzerland in a panel. The 2 chairmen, Credit Suisse, UBS, we had the SNB president, we had the FINMA regulator, the Swiss finance minister, and that's exactly what we asked. Like, what was the reasoning in wiping out AT1s, and what was the reason in giving back to a bit of shareholders? Now, they basically said, look, this is risky assets, so that's how they decided to do. But again, is this the only way that UBS has enough capital to deal with anything else? And what does the market reaction in the next couple of days give us about bondholders being confident or not that this could happen to any bank? Remember, this went so quickly, Lisa, right? 6 days ago, we had an interview with the Credit Suisse chief executive. They were at a record low, but they were fully capitalized. So it's really a market of confidence. When you lose control and actually market confidence drops and leads to deposits, like, what are your options and what are the options for bondholders? That's some of the questions that markets will want to know about other banks across the world.
Hey, Fran, I've said it a few times over the last week. Tremendous reporting on this story. Francine Lacqua there from Zurich on the latest. UBS down about 7%, recovering. It was down a lot more than that. Looking across the European bank complex at the moment, ING down 4.5%. SocGen down about 3.5%. Deutsche Bank down about 3%. No real drama there just yet. We'll stay on top of that story for you. Joining us now is Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, I've asked this question a few times in the last 24 hours. It's your turn. Are you feeling more or less confident after that tie-up yesterday?
I feel probably more confident. I feel also more confident after what's happened last week. I would feel much, much more concerned if indeed if we had perhaps sentiment and positioning much, much less really downbeat. Now, I've been listening to your show for the last eight minutes, and there's not been a lot of positives yet, right? And I think that's a fair understatement if I say that. And that's the good thing. The good thing is when we look at survey-based sentiment, that's pretty depressed already. If we look at technicals, right? So like relative strength across risk assets, already very depressed. VIX term structure sort of down to below the 10th percentile already, right? When we look at equity betas of multi-asset funds, down, right? When we look at put-call ratios, not only in equities, but across the asset classes, sending clear bearish risk sentiment signals. So the good thing is, right, with all what's been happening, not only in the last 24 hours, but really over the last week, is that sentiment has gone and has derated sufficiently really to bearish levels that I'd be very, very careful to throw in the towel on constructive views now, right? So we've just put out a note and said, look, we're still holding on to that constructive view because indeed the sentiment and positioning really across the board looks much, much more negative now, which is a contrarian positive signal.
Max, let's put a bit more specifics around this. Are you saying right now you're going out there and buying European banks to move counter to the zeitgeist that we see out there?
Yeah, I think so. I think banks are more and more looking actually attractive. If we look at, the relative performance perhaps of banks over the broader market, look at the performance of banks over tech, for example, that is back to the COVID highs, right? That's back to where we were at sort of the dizzy heights in 2020 when, real rates were down to almost record negative levels. When we look at the broader banks' performance, not only in Europe but also in the US, when we look at that against US Treasury yields, if we look at that against financial conditions in particular, it's priced right now for the second sharpest deterioration in financial conditions already, right? So there is an awful lot in the price, particularly from a relative perspective already, right? So I wouldn't say, oh, nothing's happened yet, and there's much more deeper pain to come. We're getting pretty close to pretty attractive entry levels, I think.
Let's talk monetary policy. Bob Michael sat in that chair yesterday evening from JP Morgan. He said first cut comes in September. Andrew Hollenhorst, the City, published this morning. He said you'll get a hike at that meeting in a couple of days. He said in the SEP, the projections they offer for the dot plot, the median dot for 23, he thinks 525 to 550. Max, what are you looking for this Wednesday?
I think, you know what, John? I think there's one rule right now. Don't overdo things, right? Don't talk too much. Don't change too much. What you read right now, particularly from policymakers, is steady hand, steady ship, right? What you really want is basically a 25 basis point hike. I agree with what Lisa said before. Has anyone really looked at the projections from the ECB last week? Not really, right? Because they've been only marginally changed, really. That's what you need from the Fed as well, right? You don't need overaction, right? You don't need too much. What I would do is what I'm really waiting for is a 25 basis point hike, not too much change, not too much flip-flopping around in projections or opinions or hiking or lowering the dots, but really steady hand, steady ship saying, look, we've managed to contain it so far. We can press ahead with the inflation fight. We don't need to be as aggressive anymore as we've been a couple of months ago. Let's see this through. I think that is, if we think about it and we talk about restoring confidence, the number one rule in restoring confidence is steady hand, steady ship. Don't overdo it.
Hey, Max, wonderful to get your thoughts, as always, to kick off the week. Max Kettner there of HSBC. I would say this, 2 days is a very long time in this world at the moment. We've got 2 days to go, Lisa, before we get to that Fed decision.
Hours are very long at this particular market. The fact that Max is saying, you know what, he likes banks here really shows. Okay. He has been a contrarian through and through, and here he goes.
He's sticking with it. City's Andrew Hollenhorst said it's about the news conference. Do they lean towards price stability or financial stability? Equity futures just about positive on the S&P. Coming up, Dan Morris of BNP.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least two parts. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. The three-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending the war. That plan has been dismissed by most Western governments. In France, President Emmanuel Macron's government faces two confidence votes as soon as today over his pension reform. Last week, Macron used a constitutional provision to push through the plan to boost the minimum retirement age from 62 to 64. That led to violent protests. Macron's government says the no-confidence votes won't get a majority in Parliament. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
People are doing something that probably is not rational, but totally understandable, which is they're moving deposits. And where they're moving deposits out of? The smaller and the medium-sized banks into the larger banks. And that dynamic isn't going to stop overnight. There's going to be a lot of repricing in the credit segment. So this is going to be pretty bumpy going forward.
Certainly a bumpy ride over the last couple of weeks. That was the brilliant Mohamed Al-Arian yesterday evening weighing in on the situation with Credit Suisse and UBS and the banking scenarios that are playing out worldwide. Equity futures right now on the S&P just about unchanged. Let's whip through this for you. Yield again lower by 7 basis points on a 10-year, 335.41. On a 2-year yield down about 9 basis points, 375-ish. Going into the Fed decision this Wednesday. Will we get 25? Will we get nothing? What do the projections look like? We'll ask these questions all week for you. Elsewhere, 2 names I want to look at. One is UBS. It's recovering. It's down about 7% at the moment, but that's basically a session high for the stock. It was down as much as 16% very early on in the session. The other name we need to talk about, and I keep going back to it, it's First Republic here on this side of the Atlantic. And I keep going back to the news of last week. You get 11 banks trying to restore confidence in this name, coming together, depositing $30 billion US. The stock drops by something like 33% in Friday's session, and now it's a break of 20 in the pre-market, Lisa, down another 15.
It's a confidence game, and clearly what has happened so far hasn't restored that confidence. Now we have another downgrade, and yes, the credit rating agencies have been behind the 8 ball. They've been downgrading in real time alongside the downgrade that you're getting in market pricing. But that said, how do you then entice flows back into a bank that relies on them to execute a lot of the lending that they're known for?
With great difficulty.
Yes.
And that's the problem they've got. Did you see mid-sized banks over the weekend? If you're listening at home, Lisa and I were talking about yesterday evening, mid-sized banks basically pleading to lift the cap for deposit insurance.
And again, on one hand, that gives depositors confidence. On the other hand, why would they need it, right? I mean, I think that this is the other issue. How do you restore confidence when any suggestion of a remedy suggests a problem? And I think that that's sort of the conundrum that a lot of regulators find themselves in.
Joining us now to discuss, Gerard Cassidy of RBC, a wonderful friend of this programme over the last couple of weeks, particularly as we try and work our way through a lot of this. Gerard, this is what S&P said yesterday about First Republic. This line out here I just thought was scathing. Attracting meaningful deposits will be difficult. Gerard, how do they turn that around?
Thank you for having me on the program, John. And time will turn it around, of course, but you're right. They have focused very successfully on the large, high net worth depositor. And those depositors, as we've seen with the other banks that have seen deposit flight, have been moving out. So we need to see some first quarter results. I know that's not that close. Results will probably come out mid-April, but we need to see where those deposit levels are. We saw the big banks, as you know, deposit about $30 billion into the bank last week. And we anticipate that as confidence comes back to this company, because the company has made incredible profits over the years. Its credit quality is superb, but they have the mismatch on the assets versus the liabilities, which is what everybody's concerned about.
Some people point to ongoing fear of deposit outflows or deposit catharsis, as one analyst called it yesterday, because of the discount window at the Federal Reserve and the borrowing levels rising to levels that we have never seen before, that exceed what was at the peak of 2008, one of the crisis measures. What do you make of that in terms of the breadth of the need for this capital?
It's really interesting, Lisa, because you're right. The numbers were extraordinarily high on Thursday when they were released. First Republic pointed out that they were into the window at one point for $100 billion last week. And the totals, as you might recall, were about $152 billion. So though the number was very large, I suspect that 2 or 3 banks, First Republic being one, Silicon Valley, as well as Signature, were probably the bulk of what was borrowed from the window. When we talk to the regional banks, we're seeing no evidence of deposit flight. Yes, is there some deposits leaving, but that's relatively normal. So I understand the concern, and I understand people saying, the small banks are going to lose deposits. Now, the weekly H8 data, which came out on Friday, now granted, this was for the cut at March 8th. So it was before the crisis started, but deposits are up for the small banks. We'll see what happens this Friday when those numbers come out.
Given that that really goes against the common narrative right now, Gerard, do you feel that perhaps this idea of a credit contraction among the mid and smaller banks has been overstated, that these banks will continue lending as they've had because they haven't had the positive outflows that people are talking about?
Lisa, I think you're right. And I know it's contrary to what everybody's saying, but the banks are lending based on the economic activity in their respective markets. We also have to remember many of the banks' loan-to-deposit ratios are nowhere near the highs we saw pre-financial crisis when those numbers were in the low 90% range. Many of them are in the mid-70s to low 80s, so they got plenty of room to lend if they choose to. But if we were talking about Columbus, Ohio, as you're aware of, Intel's building this new $30 billion plant. It's far different in Columbus than it is in Silicon Valley this morning.
See the numbers from Credit Suisse. Daily outflows, 10 billion a day. That was the report, 10 billion a day, Lisa. Which
was the reason why they had to come up with some sort of solution immediately, because
Phenomenal.
of it just hemorrhaging clients at the end of last week.
Jared, follow the money. Where's it going, and how close are we to the likes of Bank of America and JP Morgan saying, no, we don't want any more?
No, John, it's an interesting concept because certainly the bigger banks are receiving inflows. We know that. We'll see their numbers as well as in April. The money, as you just mentioned, at Credit Suisse was quite dramatic in terms of what was coming out every day. And it's going into banks that are considered to be well-managed, high levels of capital, high levels of liquidity. And so the bigger banks, which includes the regionals, and when I refer regionals, we're talking about banks with 150 to 500 billion in size. So they're also looked as, in some cases, as big banks as well. So all of them are seeing deposit inflows in our view, but the biggest banks by far will get the most.
Two-tier banking system is a concept we've heard repeatedly over the last week, Gerard. There is a part of the banking system people are willing to deposit cash, invest their money in, another part they don't want to go near. Do you think that's the right way of looking at the banking system in America?
I think it's a little too early to jump to that conclusion, John. You may be right. If we're talking in 6 months, it might be clearer that you're absolutely right. But I think it's a little early to jump on that because, community banks in America are woven into the fabric of this country. And I just don't, expect to see these smaller banks, their commercial customers who they've known for years, who are very tight relationships with their banks, pulling all their money out because it's a small bank. We'll see, but I think it's a little too early to jump to that conclusion.
Joe, can you do us a favour? Once I've said thanks and goodbye, can you leave your shot up? Even after you've walked away.
Seriously.
Just a bit of therapy for me in the commercial breaks. You've seen this, the dog in front of an open fire.
I mean, honestly.
The sun is coming up.
It's
the
just,
open water.
You want to keep it up. I want to get it off so I don't have to rethink
disgusting.
my life. I mean, honestly, Gerard. Seriously.
Jared
Beautiful.
Cassidy of RBC Capital Markets. Jared, thank you for that. How relaxing is that?
Is it relaxing or is it thinking,
listening to the soothing words of Jared Cassidy
and
just watching the fire burn in the background.
No deposit.
And then the dog walked in and that dog's not going to bark.
No,
that dog is so chill.
100%. It's
so chill.
A storybook right now in Gerard Cassidy's life.
Nothing chill about this market though, Lisa. We've got First Republic down 17% in the pre-market. I'm sure a lot of people thought that the actions last week would restore confidence. Didn't see it Friday. Not seeing it this morning.
No, although off some of the lows of earlier. I don't know if we could take a signal from that. I don't think we really can. I don't know what we can take a signal from, and we're not going to come up and make up narratives. But what we are seeing is definitely fear that is pervading through the financial system. And I do think that the wipeout of those bonds, I know that it sounds esoteric, I do think it gave larger fright to what else could potentially get wiped out as a lot of central bankers and authorities try to bail out some of these banks.
So tell you what Bruce Kasman's doing right now, right this second. Running around trying to find like a Zoom.
I was just about to say, painting a background on
just
Zoom.
something.
Please, compete.
Bruce Kasman of JP Morgan is joining us next. Looking forward to that conversation. Equity futures right now on the S&P, just a touch negative, no drama on the S&P 500. Yields keep heading in one direction, and that's lower. Your 2-year down 7 basis points, 376 on a 2-year, a couple of days away from Chairman Powell and the FOMC. Live from New York City. Welcome to the programme. Good morning to you. Alongside Lisa Abramowitz, I'm Jonathan Ferro. TK is going to be back in about a week from now. He's sitting this out. Might be a good idea. Don't know. Let's see how Wednesday goes. Equities totally unchanged almost on the S&P 500. On the Nasdaq, anything but through last week. Up every single day of the week. And on the week, closing higher on the Nasdaq 100 by almost 6%. Bramo, we're back to that. We're back to that in the equity market.
Again, I can't really create a narrative. At what point do people take a look at the prospect for fewer rate hikes from the Federal Reserve or even potentially rate cuts as soon as June, at least based on market pricing, and say, okay, well, that's a reason to get risk on? We just heard Max Kettner saying, if you thought that perhaps things were by a month ago, why not now? Things are even better. So you do have people coming out on that side while other people are saying, we don't know what we don't know, and there's going to be a credit tightening that hadn't been foreseen and that is new that we're seeing take place.
It's in a huge move in this bond market. Let's pick up on the 2-year, the front end of the curve right now, down another 7 or 8 basis points, 376. On a 10-year, we're down about 7 basis points. On a 10-year to 335.60. Did the ECB just give the playbook to the Federal Reserve last week? Hike, as expected, then talk about the baseline. If the baseline holds, I've got no idea what the baseline is for this Fed and how much it's shifted over the last couple of weeks. Euro-dollar close to 107, 106.89, positive 0.2%. The Fed might say they're data dependent. Dependent on what?
On which data?
On bank stocks. Take a look at UBS first. UBS, after a 3 billion Swiss franc tie-up with Credit Suisse, the stock is lower by 6.6%. I have to say it was much, much lower. Earlier in the session, we were down about 16%, so 6% lower, 7% lower off the back of this. Maybe that's a no-drama story. Elsewhere, ING, looking at European banks elsewhere, ING's down about 7%, SocGen down about 5%, BNP down 4%. I'll stay on top of that story for you. I'll stay on top of this for you too. First Republic, down 18% in the pre-market. 2 Mondays ago, this was a $123 stock. On Friday at the close, it was 23. This morning in the pre-market, it's sub 19, Lisa, sub 19.
So now the question becomes, is First Republic a specific story unto itself as it gets downgraded again and again? Or is this something that represents the lack of faith in mid-sized banks that has yet to be restored? And that, I think, will be parsed out as we watch some of the other stocks throughout the day.
What about the lack of faith in credit rating companies who had these names at IG a number of weeks ago?
Okay, not to be cynical, but was there faith in the credit rating agencies? Because they've gotten a lot of things wrong. I mean, this isn't new,
hence
right?
My phrase, the lack of faith.
But this isn't a new sort of phenomenon here. So, okay, yeah, they're following the market and fair. But at the same time, you said this yesterday, it matters for people who actually track ratings and are forced to buy or sell based on whether things are still applicable to their indexes.
Do you think because there is so little faith in some of these credit rating companies that the language they use when things get bad, they kind of double down and make it a little bit more aggressive? Because the language used yesterday from S&P, and I'll read out their quote for you. We do not view this deposit infusion as a longer-term solution to the bank's funding issues. That deposit infusion was that 11 banks getting together and dropping 30 billion into this institution. And this line right here, attracting meaningful deposits will be difficult, constraining the bank's business position. What are they essentially saying there?
I can't get in rating agencies' heads, but what I can say is this goes to the fundamental question around the business model of a lot of these companies, which is it is based on faith. It is based on this idea of confidence that they will be able to give you your deposits back when you want them. And that, I think, is the question for so many people. How do you trade around something that depends on sentiment that can be swayed by different events or different statements?
I use that phrase baseline, the base case. I've got no idea what your base case is right now, but it's certainly shifted in the last couple of weeks. There are 2 general assumptions at the moment, for the broader economy anyway, that the banking issues will lead to tighter lending standards, which will lead to tighter financial conditions, which will ultimately lead to softer growth. Torsten Slok of Apollo put this out, put a number on it over the weekend, which I imagine is tremendously difficult to do. Here's the number for you. He said, quantifying the impact of tighter financial conditions plus tighter lending standards, we estimate that the events this past week corresponded to a 1.5% increase in the Fed funds rate. The risk of a sharper slowdown in the economy have increased. Bruce Kasman joins us now, Chief Economist and Head of Global Economic Research at JP Morgan. Bruce, timely conversation. Wonderful to catch up with you. How difficult is it to equate the events of the last week with a shift in the Fed funds rate and a hit to GDP?
Well, I wouldn't try to touch that with any confidence at this point. I think it's, first of all, we don't quite know yet what the event is in terms of how far-reaching and how stressful it's going to be for broader financial conditions. I think the second point is that we do have a good sense that credit conditions in the U.S. will be tighter, but we also have a good sense that the path the Fed is on will be somewhat shallower than it would be otherwise. The other thing we should just recognize is as we were coming into this event, what we were watching was news telling us not only that inflation was persistently higher, but also that growth momentum was actually healthier in the U.S. and globally than we thought. So I think it's a very complicated environment. I think obviously the risks to the downside have increased. I wouldn't go so far at this point as being able to quantify it. I don't think the Fed will either on Wednesday in terms of making its decisions.
So you didn't have much of a weekend either, Bruce. I assume that you've been on calls for the past 48 hours pretty consistently with all of your clients and all of your peers trying to understand what is transpiring. What did you tell people? Where was your conviction as you fielded all these questions?
So I think part of my conviction was not to be confident here and not to understand the event at this point. We've increased the tail risk to the downside, but we should recognize again that the Fed is going to do less, that while credit conditions are going to tighten, monetary conditions are probably going to prove to be easier. And also to understand, again, that the economy has come into this with somewhat greater momentum than we in the Fed had expected. Again, I think the risks are to the downside. The other point I just make is that unless we're in the midst of an outright crisis where credit conditions are seizing up, this event of tighter credit is likely to play out over months and quarters. It's not likely to hit us like a truck over the next few weeks.
Okay, given that, what's your concern that we're going to see an ongoing heat in the inflation data, that the economy is going to have so much momentum that perhaps we have underestimated how much that inflation can be persistent as we all talk about the disinflation of a credit tightening that hasn't happened yet?
So, our view has been that inflation is coming down this year, but it is not going to be sufficient to be satisfactory to the Fed. And I think that's what we're tracking in the numbers. I think if you have a recession starting anytime in the next 3 to 6 months, that's going to do a lot of the Fed's job. So even if inflation stays high, you're going to see the Fed ease. If you don't have a recession and we continue to have inflation holding elevated, I think the risk that the Fed, even if it pauses in the next few meetings, that it has to come back and tighten again is still there, and we shouldn't ignore that.
So, Bruce, the cuts we're pricing right now, you'd fade that?
Well, there's a risk here that there's a financial crisis going on. There's a risk, a more elevated risk we slide into recession. If that happens, the Fed will ease, and the Fed will ease as much, if not more, than what the market is pricing in. But right now, I would not put that as the only scenario that can play out. And I think if we don't go into recession in the next few months, the Fed's not easing. I think we have to realize that the case for the Fed easing is on the back of either a financial crisis or sliding into recession.
Just how big do you think, Bruce, is the secular component to the inflation story?
I think there's a loss in terms of supply in the U.S. labor market. I think there's shifts that have gone on in supply around the world that's different, and I think those will add secularly to inflation. And I do think psychology has shifted. I don't think if we would kind of try to figure out where underlying secular inflation is, we'd have a number higher than somewhere in the mid threes or close to 4. But I don't think it's as low as 2, which is where we were averaging before the pandemic shocks hit us.
We flirted with the political aspect of the Federal Reserve and what that means for a fight against inflation that you think is going to be a bit higher than it had been pre-COVID, what we just experienced over the past 3 years. I'm curious at this point, especially with all the pushback from Congress, with the oversight, the lack of supervision of Silicon Valley Bank, this potential question around how the Fed responds to both that and inflation that is their priority. What do you think is the likely political read-through of some of these actions? In other words, how compromised is the Fed in their mandate?
I think the Fed still has all of the independence it needs to act here. There is political influence. I don't doubt that. But I think the Fed will more likely than not move 25 basis points on Wednesday. I think that's a relatively clean decision, which is weighing the stresses that we're facing here with the continued sense that they've got to fight to contain inflation. I think going forward from here, they'll probably say, let's wait and see this. I think the guidance this week will be very open as to what happens next. And I think we'll see where we are in three or 4 months. If the economy's in recession, they ease. If the economy's not in recession, inflation is still well above 3%. I think the Fed's going to be tightening later this year. And the risks have clearly shifted more in the direction of a recession, but not, I think, at this point, decisively so.
So do you think that Jay Powell is Arthur Burns or Paul Volcker?
Well, let's hope neither, for our sake.
Hey, Bruce, we've got to leave it there. Bruce Kasman at JP Morgan. Bruce, wonderful. And thanks for being with us this morning. Bruce Kasman with a tremendous backdrop too, just to throw that out there, just in case,
Wait, you want to make sure he comes back? Is that what you're saying?
I asked this question yesterday and did so through the whole of last week as well. Never mind Burns and Volcker, Trichet, hiking rates into a crisis. Oh, wait, the same again in 2011. Is that the risk they run here?
They run every risk. I mean, what we just heard from Bruce Kasman was a complete lack of certainty with anything, right? I mean, that's essentially what we hear from everybody, this sort of humility and honesty that this is so greatly uncertain with an incredible binary potential duality of outcomes. You have on one hand the potential for a sooner recession. On the other hand, the recession gets pushed off because the Fed doesn't do as much. And then the Fed, yes, perhaps eases, but then has to retighten. The sort of question around the Arthur Burns reaction to what we saw in the 1960s, 1970s.
Mohammed talked about some of this in the FT this morning. The big challenge, the trilemma for Fed policy, the conflict between all these different things, financial stability, price stability, making sure that you don't absolutely bludgeon the labour market. That's all conflicting, coming together at a difficult time for Chairman Powell.
What I would like to hear, Gerard Cassidy actually I thought was fascinating. He came out and he said he is not seeing deposits get withdrawn from some of these mid-sized banks. If you had transparency on that front, if you had someone come out and say, look at all of this. This is just truly an idiosyncratic issue. Look at all of this, books open, then maybe the Fed could raise rates by 25 basis points, hold, try to understand more, and we can move on.
I think the I word is increasingly difficult to tolerate.
Yes, I would agree with that.
Idiosyncratic. To sit here and say every single weekend after a bank has effectively failed that we've got to keep calling it idiosyncratic.
Well,
how many banks do you need to just say, actually, we've got a broader problem here?
Perhaps we just need different language. How many are there of the weaker players that potentially could be susceptible to a similar type of activity? Maybe that's more fair.
Equity futures slightly positive on the S&P by almost 0.2%. Jens Nordvig of Exante Data joins us next.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorsed the actions taken by Swiss authorities. A unit of New York Community Bancorp has taken over Signature Bank's deposits and some of its loans. Signature collapsed earlier this month. Its 40 branches will operate as locations of Flagstar Bank starting today. As part of the deal, the FDIC gets equity appreciation rights in New York Community Bancorp common stock valued at up to $300 million. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into his hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The markets are hunting. Right, and so it's looking for any weakness across financials, and so whether it's rational or not doesn't really matter. This has a tendency of taking a life on its own, and that is where we're at right now.
I had a guest on the program last week say it was seek and destroy mode. Seek and destroy. They make it sound brutal, don't they? That was Greg Peters of PGIM yesterday evening on our special coverage of a deal between UBS and Credit Suisse for $3 billion. US. Equity futures right now slightly positive by 0.1% on the S&P. All eyes on UBS trading over in Switzerland. It was down hard around the open. It's now down about 4 or 5%. So recovering there still as the day progresses. We'll keep an eye on that. Another eye on this one. First Republic is down 17% in the pre-market. I might add, Lisa, that this is becoming problematic given the the hopes that we had a solution last week to restore confidence.
Well, that's the key issue. The declines on top of all of the measures that have already taken place. And yes, we're asking, okay, well, where does it end? But it also is, what do regulators, what do some of these officials have to do if all of the measures they've taken so far haven't been enough?
Jens Nordvik joins us now, the founder and CEO of Exante Data, as well as Market Reader. Jens, wonderful to catch up with you, sir. The developments overnight, let's start there. What did you make of that tie-up and ultimately the fallout in certain parts of the debt market?
So we knew that Credit Suisse needed some form of rescue, right? And UBS had been in the headlines for a while, so that was not a big surprise. The surprise was that there were losses for the riskiest bondholders, right? So it is a long time since we have seen something like this, and we've seen repricing of risky debt. High-yield debt in Europe is a lot wider in spread this morning. So the question is whether that's a repricing, just a kind of we need to reset, or whether we move on to different banks and it doesn't stop with Credit Suisse, right? So I think that the difference to 2008 is that in 2008 we had the entire banking system loaded with mortgage bonds that we couldn't value, right? And this occasion, it's more a liquidity issue. Certain entities have serious liquidity issues. But we don't have the same kind of asset losses that are hard to quantify. We obviously have losses on bond holdings for sovereign bonds, but those are very easy to value. So that's the difference. And we'll really have to watch whether there is a next shoe to drop here, or whether the European banking system is now actually starting to look a little bit more resilient than the U.S. system, which is impacted by, obviously, the regional issue that is specific to the U.S.
Do you buy that? I mean, Jens, we're not seeing that necessarily in the market activity this morning in terms of just how much certain European banks have sold off. But do you think that European banks are a better buy and a better sort of more optimistic approach than the U.S. banks right now? Is that correct?
So I think we have in Europe more concentrated banking systems where it's typically 2-3 big banks in each country that account for most of the assets. And in a way, in a situation where it's good to have implicit government backstop, that's a good thing. Whereas in the U.S., we have this very fragmented banking system where half of the assets are within the smaller banks, right? And we don't have any explicit backstop. In fact, the Dodd-Frank regulation made it very clear that we're not supposed to have any backstop of that nature. So there's a difference. And I think also in terms of deposit dynamics, right, we clearly have sort of erratic deposit dynamics in the U.S., as we could see in the Fed data last week. And in Europe, that's a little bit different. I don't think we've seen that yet. So there is a difference. But obviously, the confidence shock that has come out of Credit Suisse, we need more time to assess whether that was really specific to Switzerland or whether it's something that's going to migrate into the Eurozone banks as well. And so far, the jury is out, right? We've had a repricing today, but investment-grade credit is actually coming back now in the last couple of hours. And I think that's worth watching very, very carefully.
When we talk about nodes of contagion, you were talking about the contingent capital bonds. Bob Michael of JP Morgan Asset Management yesterday was talking about who are the holders of these bonds, who are going to be taking down some of those losses, pension funds, foundations, big institutions that then are going to reduce risk elsewhere. What's your view on that as a potential node to watch?
Yeah, I think that's really important, right? So that's exactly why I have, all those credit indices at the top of my screen today, right? So we can see everything in the risky part of the credit structure got repriced down. Totally logical. That makes sense. And then if you look at IG credit, where you can really worry, okay, we're going to have contagion into that space as well. We were down a lot a couple of hours ago, and now we're coming back. So if IG credit is holding up, i.e. the contagion is sort of really limited to the most risky part of the capital structure, that actually is a source of resilience. So that's what we have to watch today. Does that hold up? And I think you can also see within the bank stocks that it's really the riskiest banks that are seeing some tension, and the other ones, the higher grade banks, are actually starting to come back as well. So it's a quite nuanced picture here, and we have to also separate what is the liquidity situation that can be addressed, what are underlying solvency issues, right? And don't forget, European banks have been trading the best in years up until the Silicon Valley bank problem, right? So it's a very different situation from the Euro crisis, for example.
So, Jens, this financial instrument we're talking about, this security, the convertibles, this was an important tool to attract capital, to raise capital for the banks, and ultimately restore confidence in the European banking system to make sure everyone understood they were well capitalised, etc., etc. And at the start of the year, to your point, Jens, this was meant to be the real reset for the European banking story. Higher rates, a better economy, a better story, flows start to come back into the Eurozone, investor flows in a more material, pronounced way. Jens, there was an FX call associated with that, and I wonder how that's reset for you.
So I actually would stress that the biggest change in capital flows in Europe is that we used to have 0 or negative rates in Europe, and we had a steady flow out of Europe into global fixed income, EM, and the US. With interest rates now 3-4% in the Eurozone, investment managers in the Eurozone don't need to go abroad to get fixed income exposure. So that's the big change, so that money can actually stay home. And obviously, we'll see what the ECB does in coming months, but if they continue to raise rates, that effect will become more and more powerful, and that will in itself be euro supportive and could be negative for the other places where that money used to go. So that's a key thing to watch, and it could be super important for the euro.
So euro dollar establishing a new floor. Are you thinking about a higher ceiling? Jens, how do you think about that?
If we can avoid continued banking instability, the ECB will continue to go. They've said so over the weekend even, right? So that's the path that they want to go down. We'll see if the market allows them to. But if they continue to go down that path and we don't have like severe instability, that could be a source of support for sure.
So Jens, when they say data dependent, do they mean the price of bank stocks?
Well, they put it in very explicitly in the wordings, right? So there's no doubt that we essentially have, okay, we watch the growth, we watch the inflation, and we watch what's going on in the financial sector, right? So those are the three dimensions, and that's what is new over the last couple of weeks.
Monetary policy is now bank stock dependent. Jens Nordvik there of Exante Data, a market reader. Jens, wonderful. Thank you, sir. That's where we're at, going into the Fed. And if you believe we're bank stock dependent, then 2 days is a long time in this market going into that Fed decision.
We were bank stock dependent right now. We were University of Michigan sentiment survey dependent a bit ago. We were
Wasn't that ridiculous?
We were JOLTS survey dependent quite a bit ago. It's a moving target, and I think that's what makes it so difficult. Data dependency is a bit tricky to get your hands around when the data keeps switching in terms of the importance of it and the frequency of it.
It felt easier when it was about you, Mitch, and leaked stories to the Wall Street Journal. We're going to go big. Didn't it feel easier back then?
I mean, maybe, but they weren't getting it right. I mean, honestly, they still missed a number of different things. Are they getting it right now? Well, that's a good question. I don't know. I wonder, as Jens was talking, how much does the euro rip if we see the Fed hold rates where they are on Wednesday after the 50 basis point rate hike from Christine Lagarde last week?
It depends why you think they're holding rates. Does that spook people? Is that a global contagion story where people start to get worried?
You sound beleaguered right now.
The reason I ask this, and I know that smart people say that's not how this is going to work, that's not how these people think. We reported last week that's precisely how the ECB went about conducting policy last week.
I don't think anyone would at all question why you would say that, because everyone knows how much this is a game of psychology. What I would say is it seems like right now there is an unknown about how the market responds even to the central bank moves. And you were saying, it depends on why. There's sort of a beleaguered sense of even if you know what they're going to do, who knows what the market response is going to be and how it's going to be taken and played out in the market. I mean, they're dependent on something that's dependent on them and on psychology. This is just a cycle.
Yeah, you'll drive yourself nuts trying to work this out.
Yep.
UBS is improving. It's down about 4% in early trading over in Switzerland. It was down a lot harder than that around the opening bell. The other name to watch at the moment is First Republic. That's down about 21% in the pre-market, down 21% after falling 33% on Friday's session. Going into the close, so we trade in and around 18 in the pre-market on that name. Dan Morris of BNP Paribas is going to join us next with equity futures on the S&P 500. Looking a little something like this, positive, 0.1%.
That a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Another long week coming up, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK is going to be back next week for you. Equity futures right now unchanged on the S&P 500. Lisa, another weekend putting out another fire.
We had narrative after narrative after narrative all year. It's been one day, one narrative, next day, new narrative. And over the weekend, we took all those narratives, threw them up, and everyone's trying to grasp the one that they can still cling to as they try to come up with some sort of compass for the week ahead.
I won't give you my view. I'll just frame the range of views out there right now on UBS. UBS is down 4%, was down a lot more than that a little bit earlier in the session. Here's the less constructive view from KBW. Considerable uncertainty around the earnings trajectory. Here's the more constructive view from B of A. The logic of the deal, Lisa, quote, impeccable. The cost synergies, quote, substantial.
So here are the two sides of it. On one hand, this allows the UBS to organically grow in the U.S. This has been one of the big pushes. It allows them to consolidate even more income-driven kind of wealth management oversight as well as deposits. On the flip side, what are the unknowns that caused UBS to demand a $9 billion backstop or 9 billion Swiss franc backstop to any potential losses, wipe out the AT1 holders, as well as a $100 billion liquidity line from the Swiss National Bank? Raises some questions about what they saw under the hood.
Oh, to be clear here, if you knew that they could get the Swiss unit for $3 billion, you'd be like, wow, that is some deal. How much time did they have to do due diligence on this? We understand, based on what we're told, is that talks really started to get going on March 15th, then really started to accelerate through the weekend. Goes to your point, there's so much we don't know about what's under the hood once you lift the lid on the bank and how much work there is to do to integrate it.
And this is going to be 3 to 4 years of integration. And you heard UBS say to a lot of their workers, we're still competitors with Credit Suisse. I mean, there still are so many questions right now as you try to parse through what this means. So when you take a zoom out as far as does this stave off the contagion, we don't even know what the problem was that required such a quick response. Yes, we know it was deposits that were outflows from Credit Suisse. But beyond that, what else is going on?
Whenever there's a crisis, you throw around an acronym. So the new one that people are throwing around, AT1. AT1. What happened yesterday and why is it so important?
These are contingent capital bonds. It's a $275 billion market that was intended and grew out of the financial crisis to be bail-in bonds. Basically, they would be the first loss types of bonds as you saw banks hit their capital thresholds, right? What we saw yesterday is, yes, they were wiped out in this acquisition deal. But even more, and you pointed this out really smartly yesterday, equity holders are still getting something. So basically what we have learned is that they are the lowest tier on the capital structure and get wiped out before equity. And that is a game changer that's causing all of this debt in this $275 billion market to get written down in a massive way.
Well, this is what Greg Peters of PGIM said. There was always this equity-type risk associated with the instrument, and now we're finding out, no, it's actually riskier than equity in some cases.
And the Swiss National Bank, the regulator, I should say, FINMA over in Switzerland, single-handedly rewrote the rules for this entire market. So how much pushback do they get from some of the other regulators as well from Europe?
So UBS right now is down 3.7%. That improves. Over in Europe and the rest of the banking universe right now, ING's down about 5.6%. SocGen's down about 3.5%. I wouldn't call that dramatic. I'd call this dramatic, to be honest with you. First Republic in the pre-market, down 20%, Lisa, after losses on Friday of more than 30%.
Right, raising questions about what they need to do, what they need to see in order to stave some of the flight of investors, at least, if not depositors. We're watching a number of things today, but really there are only two themes. It's central bankers and it's what happens in the banking complex. 10 a.m. we hear from President Christine Lagarde of the European Central Bank. Does she give some nod to what we have seen with UBS and Credit Suisse, to the potential concerns around what happens in other banks? Today we have an incredible lineup, including Bill Dudley, former head of the New York Fed, Michael Arougheti of Ares Capital, co-founder and CEO. We also have Leon Cooperman of Omega coming out and talking about what he expects at a time when there is a big question about the private market's role in all of this, as well as contagion in the private markets. And then, of course, Tuesday through Wednesday, the Fed will meet and the Fed will decide something. This is a big unknown. We don't know what they're going to decide, and we don't know how the market's going to respond. But what we have seen is a complete re-rating of Fed rate hikes. They have been wiped out of the market in terms of market expectations, and now we're pricing in cuts as soon as June, with that 2-year yield declining by more than a full percentage point since earlier this month.
Markets made the call. They're done. It's making the call again this morning. Front end of the yield curve down another 7 basis points, 3.76. So we were north of 5 a couple of weeks ago. Now we're well south of 4, and we've taken out all those hikes and we're pricing in a real cutting cycle.
This is unprecedented in the speed of repricing rate hikes and rate cuts and just sort of the tumult that we've been seeing. So at what point does that in and of itself cause turmoil? I mean, if you think about how quickly some of these benchmark instruments are shifting around, you just wonder what the read-through effects really are.
It was only 12 months on the 16th from the first hike. It's only 12 months ago.
I'm dizzy.
0 to 450 and like that. Dan Morris joins us now, Chief Market Strategist at BNP Paribas Asset Management. Dan, a theme of the morning so far, and good morning to you, and welcome to the programme. A theme of the morning so far for us is this theme, data dependency. Are they now just dependent on this one data point, the price of bank stocks?
Well, I think it goes broader than that, but there's another wrinkle to this, not obsession, this need to look at the data for the central banks to make the decisions. It's all the more challenging now because, as we've seen with the non-farm payrolls data, with the retail sales data, you can't always trust the data. So, yes, you're waiting for the next data point, but particularly there has and will continue to be a problem with the seasonal adjustment factors, which make the inflation that we're getting something that you have to take with a little bit less confidence than you would. So certainly we care about the bank stocks, but we do have to remember that the fundamental backdrop here is too strong growth, a too tight labor market, inflation well above target, and that's what makes us think the Fed is not going to be able to do anything like the market seemed to be pricing in terms of cutting rates by June, as you mentioned.
Dan, how many times so far this year have you changed your overall parameter for what the outlook looks like and what your base cases are?
I don't think we've changed all that much. I mean, certainly the market seems to swing from one extreme to the other, but pretty much for quite a while now, the view has been that we are probably going to need a recession in order to get inflation down, at least in the U.S. Now, what's changed with the events over the last couple of weeks are the parameters, the path towards that recession. I mean, it's certainly fair to say that given the slowdown that you'll see, say, in credit lending from the banks because of the turmoil, that will slow growth. That will bring down inflation. So the Fed doesn't need to do as much as you would have thought 2 weeks ago. But we still think the end point here is a recession in the U.S. because otherwise you're not going to get the unemployment rate up high enough. You're not going to get wage growth down enough to get inflation back to target.
There's a concern that if the Fed does pause or even start cutting rates as soon as June, as the market is certainly pricing in, that the momentum that we keep talking about and the inflationary impulse that has been hotter than many people expected will get a bit carried away, and it will force the Fed to have to retrace their steps and tighten policy within the next 12 months even more. How significant is that possibility in your view?
Well, there's a couple scenarios. I mean, certainly one is we've already had kind of seen this renewed overheating scenario, which is what led the previous increase in Fed funds expectations. And of course, we were talking about 6% not that long ago. So certainly a cut in rates you could see having one of two effects. One, ultimately, it's going to stimulate growth. It would stimulate inflation. And you're right, would you have to retrace it? On the other hand, the risk that would seem to suggest, my gosh, there really is something very bad going on. Why else would the Fed cut? So you would think from a confidence point of view would certainly be a consideration for the Fed. So between the worries about confidence and then, again, fundamentally the need to slow growth above and beyond what we're going to see with what's happening with the banks, it would argue that really they should continue to hike.
Dan, where does this leave this NASDAQ trade? Up every single day last week with the exception of Friday, higher on the week by close to 6%. Dan, where does it leave that trade?
If you compare the performance of the U.S. and the European equity market, people have pointed out how U.S. equities have done so much better, but it's really only because of the performance of the tech sector. Every other sector between U.S. and Europe have performed pretty much in line. So you've had a big boost to the valuations for tech stocks because of the decline in discount rates, because of this decline in policy rate expectations, essentially the reverse of everything that happened last year. So that's what pushed up the valuations and helped the stocks to perform. But, fundamentally, we don't think the view that the market has about the path for Fed funds is the right one. We think it's going to have to go back up, which would suggest a lot of what we've seen is simply going to unwind at some point.
Dan Morris of BNP. Dan, thanks for that. Not the only one who thinks maybe this rate pricing has gone too far. Think about where we've been so far year to date. Lisa touched on that. You alluded to it. We priced in cuts. We priced out cuts, priced in hikes, priced in something close to 6% at one point as a terminal rate. People were discussing that. And now we're pricing in cuts again and basically saying the Fed is done. We've seen the peak and cuts are in our future.
This is unprecedented. I really can't stress that enough in terms of the pace of the ups and downs with respect to pricing in and pricing out rate hikes and rate cuts. And it highlights the complete uncertainty. At a certain point, you have to wonder at what point people say, look, if you're pricing out cuts, it's for a reason. And it's for slower growth, and that's going to hit all companies. And you're not necessarily seeing that narrative take hold in markets fully yet, this full uncorrelation that we used to see back in the day.
I couldn't agree more. Not all cuts are created equally. If it's because of immaculate disinflation, wonderful. Buy whatever you like. Things are looking good. I get it. I get the argument. We go something like that. If it's because people think things are breaking, there's evidence they are, that's not good, is it?
Especially for capital creation, especially for some of the riskier aspects of the market that got inflated from lower rates. This is a different lower rate regime if rates are cut than, say, 3 years ago when it was done to just fuel ongoing free money that a lot of people got used to.
UBS improving as the session grows older. UBS is down about 4% or so. First Republic in pre-market trading, not improving much at all. We're down about 18%. On First Republic in the pre-market. Keep an eye on that, 1888. Coming up in about 20 minutes from now, we're going to catch up with Bill Dudley, the former New York Fed president and Bloomberg opinion columnist. That conversation coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least two parts. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. The three-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending the war. That plan has been dismissed by most Western governments. Bitcoin rose to the highest level in 9 months. The largest digital asset went over $28,000 for the first time since June. Now, Bitcoin is up almost 70% this year. Analysts say the rally is due to the turmoil in the banking industry, higher than expected inflation, and hopes for a dovish Federal Reserve. And a group representing Uber, Lyft, and other app-based services is raising concerns about President Biden's choice to head the Labor Department. The issue is over Julie Su's stance on worker classification rules. The group wants Su to explain how she would implement the rule that could make it easier for workers to be considered employees rather than independent contractors. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Remember, the Federal Reserve Bank and Jerome Powell are ultimately responsible for the oversight and supervision of these banks. Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason.
Senator Warren there speaking on CBS over the weekend. Now, I think a lot of people like to take a dig at Chairman Powell, but this line right here, he said that all he wants to do is lighten regulations on banks. I mean, I don't remember seeing him say that or hearing him say that.
Come out and say, all I want to do
all
right now.
All I want to do is lighten regulation on banks. Now,
okay.
That's not to excuse him from everything else that's happened.
All right, she's
over the
overstating
last couple of weeks.
Let's
of course.
be very clear. She's
well, politicians tend to do that.
Yes, exactly. There are some questions about Randy Quarles in his role as the head of supervision for the Federal Reserve and what didn't happen, particularly with Silicon Valley Bank. And there's some real questions that need to be unearthed. My question is, how much does that complicate the Fed's role that they're trying to execute now in terms of political interference and political questions? And that really, to me, is a main question, as Jerome Powell clearly wants to fight inflation, but also not undermine the financial system.
Well, let's park the political digs just for a moment and think about policy. The senator from Massachusetts was asking the right question about FDIC insurance, whether we should just get rid of the cap, whether it should be $1 million, $2 million, $3 million. These are questions we need to answer pretty quickly.
And then decide how much banks have to pay for that insurance, right? I mean, that was something else that Elizabeth Warren was talking about. If you have, say, $2 million of protection, what's the right risk premium? Because essentially, otherwise, you have just the taxpayers of the United States holding the bag yet again. So how do they ensure that that's not exactly what's going on here?
Square this circle for me. How can you say it's not a bailout or tax-funded in any kind when we know what's going to happen here? The consumer's going to bear the cost.
The only way to do it is to charge enough of a premium to some of these banks for that insurance. But if you do that enough, then it reduces the business case for them and it crimps the lending to a lot of the smaller businesses and a lot of the individuals. So really, this is a difficult one, and she's trying to make it simple. It is not simple, and a lot of people are going to be hashing this out.
Let's work through the price action. Welcome to the programme. Equity futures down about 0.1% on the S&P 500. The bond market set up as follows, down 9 basis points at the front end. Let's call it 375 on a 2-year yield. Backing away there again, 2 days out from Chairman Powell. 2 names to watch in early trading. I'm looking at UBS, down about 5.5%, recovering from the losses of this morning at the open in Swiss trading. That stock was down 16% at one point. That's brutal. Elsewhere, this is brutal. First Republic down another 19% after the big move lower on Friday, down more than 30%, down another 19 to 18.73. in the pre-market. We're struggling to restore confidence in some of these names, aren't we, Lisa?
And that's probably going to be an ongoing problem. We don't know what the problem is that regulators are trying to fix. I think that's really the key, because if this is a crisis of confidence and they keep coming out with more measures, well, what are they seeing that we don't know? And I think that was really a question with the UBS Credit Suisse tie-up.
You know what was staggering to me over the weekend? Just the silence from the Treasury, just a lot of quiet from the administration. Did you notice the same thing?
Until last night, when they came out and said, we're so grateful that they came up with some solution. What else are they going to say? And then say, we're going to open up swap lines to prevent, potentially some sort of shortage of dollars. But you're right. What are they going to say?
And that's the difficulty. What can you say? Let's talk about policy. AMH down in Washington, D.C. Anne-Marie, welcome to the programme. As always, good morning. Walk me through the policy effort this week. What does it look like?
Well, John, also speaking of what you were just mentioning about basically the quietness we've heard from Treasury and the Fed, the statement they put out was 3 sentences long. And one thing they spoke about in this statement was that they see this resilience in the U.S. banking. This week, there's going to be a lot of questions on Capitol Hill about what went wrong, starting with the collapse of SVB. You already heard from Senator Elizabeth Warren. She wants to go down the regulatory path. We've also heard from Patrick McHenry. He's the chair of the House Financial Services, alongside the top Democrat on that committee as well, Maxine Waters. They put out a statement on Friday talking about the fact that there's going to be a hearing on all of this starting on March 29th. There'll be more hearings to follow, but they will be starting with the FDIC chair as well as the vice chair of supervision at the Fed, Michael Barr. A lot of questions about, was this a regulatory issue? Should there be a rollback of what happened in terms of Dodd-Frank in 2018? Or were some regulators potentially not paying enough attention? And that really is what you heard from Elizabeth Warren when she was going after the Fed chair, Jerome Powell.
To be clear, in 2018, there were both Republicans and Democrats who voted to roll back some of the measures for smaller banks. Republicans, though, have been the party of deregulation for a while. That has been the reputation. Have there been any Republicans that have come out after this and said, we think that more regulation is in order?
No, what you'll be hearing from a lot of Republicans and also a lot of Democrats as well is that they want to first have an autopsy of all of this. They want all their information before they start throwing around this idea of legislation. Also, they all know that it's not possible in this divided government. You have the Senate controlled by the Democrats, the House controlled by the Republicans, and Lisa, you make a great point, which is the fact that 17 Democratic senators voted to roll back Dodd-Frank. I'm talking about individuals like Chris Coons, Joe Manchin. These people also still have their Senate seats today. And then there was 33 Democrats in the House. When the President of the United States, then, former President Donald Trump, signed this legislation, he called it a huge moment of bipartisanship and something he wanted to continue. So don't think that there's going to be regulation and legislation for that. But a lot of Democrats will use this, obviously going into 2024, as a rallying cry. But then you have, on the other hand, the Republicans are going to be using this, saying that they're going to attach at any moment they can the word bailout with the Biden administration.
We were talking earlier about the FDIC insurance cap and some of the questions around what legislation would emerge from that. Is there real discussion around what that premium should be that banks pay for deposit insurance and what the cap should be? Is it $2 million? Is it $3 million?
Well, this is something Senator Elizabeth Warren wants to look into, as well as others, because right now what you have is the FDIC basically saying all deposits are insured on just these certain banks. But it has set this precedent. So now this is a talking point of whether or not this needs to be adjusted. And to Senator Warren's point in that interview, she was saying the discussion is, what is that threshold going to be? When the FDIC invoked this measure, it was because of systemic risk. And that is something we heard Secretary of Treasury Janet Yellen say in Congress. So if there's systemic risk, is that when the FDIC is able to lift that limit? But this is something that's going to be a talking point, and potentially this could have bipartisan support, because no lawmaker wants to go home, tell their constituents, especially small businesses, which keep much larger payroll capital, higher than $250,000 limit in their banks, that they don't want those funds to be uninsured.
So, AMH, just to be clear here, the conversation is now what the cap should be, not whether we should have one or not. Where is that conversation?
Yeah, I think it's a little bit of both. I think it's one, what happened with SVB and lifting this threshold and making sure that these insurance deposits, that individuals get their money back. I think that has led to this discussion of why do we have a cap, should we have a cap, and if we were to have a cap, does the limit need to be lifted?
AMH, down in Washington, thank you. Following those comments from Senator Warren over the weekend, Senator Warren certainly not alone, Lisa, on that front.
No, and a lot of people are saying this is really the only answer, especially given that there has been some sort of implicit guarantee that can't be removed now, right? I mean, basically, policy written down, codified by legislation has to follow what effectively has been the de facto policy put in place by what we heard from Treasury Secretary Janet Yellen and the FDIC last weekend.
UBS looks like this morning. Good morning to you and welcome to the programme. If you are just tuning in, we're down about 4.7% on UBS. Elsewhere, First Republic still lower by 18%. Another downgrade from Standard & Poor's after the downgrades we saw last week from Fitch and Moody's only a number of weeks ago. This was rated investment grade, and now it's junk by all of them. Equity futures on the S&P 500. Equity futures just about unchanged, and the bond market doing its thing. Its thing currently is just to rally and send yields lower by 8 basis points on a 2-year. The 2-year 3.76 on a 10-year. Let's call it down 7 basis points to 3.36. A couple of days away from Chairman Powell. The look ahead up next with Bill Dudley, formerly of the New York Fed. Few hours away from the opening bell. Let's work through the situation together. Equity futures unchanged on the S&P. On the Nasdaq last week, doing nicely on the Nasdaq 100, up every single day with the exception of Friday, up on the week by close to 6%. In the face of this in the bond market, your 2-year yield lower again this morning. 2s, 10s, 30s shaping up as follows. We're down 7 or 8 basis points on a 2-year throughout much of the last few hours. 376.76 on a 2-year going into Chairman Powell on Wednesday. The 10-year down 6 basis points, 336.90. Over in Germany, the German 2-year down another 11 basis points, 24,225. Bear in mind that was 340-ish only a couple of weeks ago, so big turnaround there too. Euro dollar 106.98, euro dollar positive 0.2%. Much confusion, Lisa, about what happens now to the AT1 market, and the Europeans are pushing back against what goes first when banks get resolved.
They say the bylaws say that equity needs to get wiped out first, and they've come out with statements trying to reassure the entire $275 billion market that actually equity gets wiped out and then they take losses, which is different than what we saw in Credit Suisse. So first of all, what lawsuits ensue? Second of all, did the Swiss regulators act single-handedly without really getting any weigh-in or buy-in from the other European regulators? And third, what does this mean in terms of how much confidence people can get if it's sort of changing on a dime?
So there's a bit of a grey area here. There's what's in the prospectus, and it's quite detailed, one. And two, it's perception of this market, and it's what people thought would happen or didn't think would happen. And you heard Greg Peters-Appigium yesterday. There's a really well-educated man in fixed income who turned around and said, I've always struggled with how to value this market. I don't really understand it. And if you didn't understand it before, then maybe you really don't understand it now.
Especially because it's ultimately dependent on contracts. And if the contracts aren't necessarily held in the same kind of way, all of a sudden you start to really raise some serious doubts. Okay, the stocks that I'm watching, I want to go through a number of the banks, both European and U.S. You can see UBS clawing back some of the losses from earlier this morning. They're down now less than 3%, 2.3%. So really trying to reassess whether they're getting a bargain or a bad deal. More people kind of weighing in on the bargain side as time goes on. JP Morgan shares are lower by 0.6%. Not a lot of drama given some potential uncertainty. And Bank of America shares are actually up now 0.3%. In the mid-sized banking in the United States, First Republic shares, yes, they are the outliers in terms of carnage, down 18% about in pre-market trading. But Western Alliance and PacWest, two other banks that we've been watching, are up and up considerably, up 7.3 and 15.8% respectively. I find this interesting because it highlights that perhaps we have gotten to a place where there is more confidence. And I want to end on oil because we haven't really talked about oil. Goldman Sachs came out over the weekend and downgraded their expectation for the full year to below $100 per barrel. You have seen people continually retrace, and you see all the oil majors lower on the day. No drama, all down less than 1%. But still, John, I think it's interesting to note the read-through of what slower economic growth means, tightening credit conditions, and the read-through in different parts of the market of how that's going to really affect growth.
Well, here's the read-through for the Federal Reserve from Goldman Sachs and Jan Hatzius. Here's the first line in their report they put out this morning. We expect the FOMC to pause at its March meeting this week because of stress in the banking system. So they're going with pause. How many others fold going into Wednesday?
Right now, if you base it on the markets, all of them. There are, well, actually, around the margins, people are kind of waffling around. But a lot of people are saying, how can they raise rates at a time when something is breaking? And they always said, we're going to hike until something breaks. Well, aren't we there?
2 weekends, seen things break, haven't we? 2 weeks of it, and maybe we have another weekend. Jan went on to say the following. While policymakers have responded aggressively to shore up the financial system, markets appear to be less than fully convinced that efforts to support small and mid-sized banks will prove sufficient. Goes on to say this, and I think this is the important line. We think Fed officials will therefore share our view that stress in the banking system remains the most immediate concern for now. Now, the end bit there, for now. Now, is a pause the end, or does a pause lead to the restart if you're able to resilient or rather insulate the financial system? Do you get a pause and then restart again?
What hazard? That's all I can say. Talk about whether you create a beast here.
Yep.
Because if you pause and say, we're just going to watch the bank stocks and decide whether or not to hike rates at the next meeting, this creates, again, just the shifting data dependency as to what data you're watching and the relevance of it in a broader sense.
The link between a single 25 basis point hike and the future inflation rate is very tenuous. Goldman went on to say the FOMC can get back on track quickly if appropriate, and the banking stress could have disinflationary effects. That's the take from Goldman this morning.
You know what it says to me?
What's that?
Nobody knows. Nobody knows anything, and people are just basically saying maybe just wait and see what happens.
That's the one thing we do know.
Yeah, exactly.
That nobody knows. Bill Dudley might know. He joined us now, the former New York Fed president and Bloomberg opinion columnist. Bill, let's go there. Goldman says pause. Pause because of stress in the banking system. Bill, your best guess right now, what would it be?
I think it depends on where we are on Wednesday. I think we know they're not going to raise 50. I think we know they're not going to cut rates. The real question is 0 or 25. The case for zero is do no harm. We know that the banking system's under stress, so why would you continue to raise rates when the banking system's under stress? The case for 25 basis points is to say, look, we still have an inflation problem. We can do both. We can use our liquidity facilities to shore up the confidence in the banking system, and we use monetary policy to bring down inflation. If I was sitting there, I guess I would probably recommend just taking a pause. But you have to do it in a way that doesn't alarm people. One of the problems of pausing is people are going to say, gee, why is the Fed pausing? Things must be worse in the banking system than we think. I think this is a very different situation than the great financial crisis in the sense that the banks, this is a question of confidence in banks due to uninsured deposits and mark-to-market losses. It's not about the economy that's collapsing. In the last recession, during the great financial crisis, we were in recession beginning in December 2007. We're not in recession now. The economy is actually doing pretty well. And the banks that we're talking about that are under stress in the United States, very small share of the total banking system. So I think it's important to recognize that this isn't the great financial crisis all over again. It's a lack of confidence in banks because especially those banks with a high proportion of uninsured depositors and mark-to-market losses on in their portfolios.
All that said, Bill, do you still think that this Fed should bring a monetary policy, should bring their terminal rate to 6% or possibly above that based on the inflationary pressures if there is this ongoing tightening that people expect from smaller and mid-sized banks?
That's really the $64,000 question. How much is this stress that we're seeing today going to result in tighter credit conditions that are going to change the trajectory of economic growth? I don't think the problem is the credit conditions right now. I think the problem is mark-to-market losses in the portfolio and uninsured deposits. It's very different than the great financial crisis when we had this housing boom and bust. And it was the bust that really took down fundamental values in the banking book and also damaged households enormously because households had used the rise in home prices to pull money out to support their spending. The U.S. economy is fundamentally in better shape today. Household and business balance sheets are strong. So this is, I think, more about confidence in the banking system. One reason why we're having more problems this time, though, last time there were big banks that were willing to ride to the rescue and buy the banks that were under distress. They're much less willing to do that this time because last time when they did this, they assumed huge legal liabilities that they hadn't anticipated. A second reason why big banks don't want to ride to the rescue this time is if I buy a bank and get bigger, I could be pushed into a higher, what's called a SIFI surcharge bucket, with a higher capital requirement based on my size and complexity, which would apply to my entire book of business, not just the new part that I just acquired. So you don't have the, people that come in to, buy the banks that are under stress like you did last time.
Given that you don't see this as a 2008 redux, maybe you don't get the white knights coming in to bail out these banks with an acquisition, as you point out. But a lot of people are writing into me and saying you live under a rock of bearishness. You don't understand the momentum that you're seeing throughout the world and throughout a lot of communities in the United States. Given that there is this sort of momentum, do you think that it's folly for people to be pricing in significant rate cuts, more than 100 basis points of rate cuts from now until the end of next year, or until the end of January next year, I should say?
That seems very premature to me. I mean, that means that the Fed has basically failed in terms of providing a credible liquidity backstop. And I think the Fed can succeed in providing a credible liquidity backstop. In fact, the steps they've already taken, I think, go a long way towards that. I think the Fed, if I were sitting at the Federal Reserve right now, I'd be asking myself the question, how can I do more on the liquidity front so I can free up more flexibility on the monetary policy side? Because if we can restore confidence in the banking system, then the Fed can use monetary policy to bring down inflation.
Do you live under a rock of bearishness? Is that what someone said to you?
Well, I've not in that many words.
Pretty
but
brutal,
no, they say other things, like you're a pessimistic, horrible human who doesn't ever think positive things. But I do. It's just that I worry.
Who says that to you?
Oh, a lot of people.
It's nasty, Brammer.
It's
we
okay.
all love you.
Well,
okay.
Oh, that's sweet. But it's okay. I can deal with it because I'm prepared, because I'm duly bearish. But I'm not. It's just realistic. It's trying to understand the unknowns.
Looking around corners.
Exactly.
I get it.
Thank you.
Bill, a couple more questions if I can. I got this one over the Bloomberg moments ago. And someone watching wants to know whether you think the gap between Fed funds and bank deposit rates matter here. Has that contributed to the problem?
I think banks have been slow to raise their deposit rates because they've been awash with deposits. I mean, what happened when the Fed was doing quantitative easing was it's buying securities, and that cash from those securities purchases was actually flowing into the banking system. So banks have actually been pretty slow to raise their deposit rates. You know, when people look at the mark-to-market losses on their securities portfolio and their loan book, that has to be offset by the fact that banks are actually doing quite well in terms of the deposit base. The value of a retail bank network today, branch network today, is much greater than it was when interest rates were at zero. So when you're looking at the banking, asset liability mix, you also have to count the value of those deposits, which is really quite high right now. For most banks, net interest margins have actually been expanding. Silicon Valley Bank was a very important exception.
Bill, I just want to weigh in as well on the balance sheet. I'd love your thoughts on that. As we know, there's been a rush to use the discount window. The new facility that was opened by the Federal Reserve just last weekend will encourage perhaps more of the same. Can you tell me whether, just because the balance sheet is expanded again, whether that means it's the end of QT? How do you think about these things?
I think this is about exceptional liquidity, lender of last resort provision to support the banking system. I think quantitative tightening, the runoff of the Treasury portfolio and the agency mortgage-backed securities portfolio is going to continue unabated. I see these tools as very separate and different. So I expect that the quantitative tightening will continue.
Bill, wonderful to get your thoughts. As always, Bill Dundee there, the former New York Fed president and Bloomberg opinion columnist, going into Wednesday with Chairman Powell just around the corner.
Do you think he's just sort of sitting there in his room? Like, why me? Why do I have to do this?
Chair Powell?
Yeah.
You think that's how he psychs himself up?
I don't know. What do you think he does?
The Fed decision.
Does the Rocky soundtrack?
No idea.
Upstairs?
Does he ride his bike or something like that?
Well, I
couldn't really care less. Equity futures on
How do you really feel?
Negative a tenth of 1%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government-brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorsed the actions taken by Swiss authorities. First Republic is set to extend its record loss today. Shares of the bank are plunging in pre-market trading after S&P Global Markets cut its credit rating again. Last week, some of the biggest U.S. banks pledged $30 billion in cash for First Republic in an attempt to stem the turmoil. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. And Volkswagen is planning an even cheaper electric vehicle. VW brand Chief Thomas Schaefer told German magazine that there could be a model selling for less than $22,000 as early as 2026. Last week, VW unveiled an EV that will sell for less than $27,000 when it reaches showrooms in 2025. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've had a recognition that the inverted yield curve has, hampered the balance sheet on a paper basis of some niche banks. And when the first crisis happened in 2008, the whole issue was systemic collapse. We don't have a systemic collapse now. We have a crisis of confidence, and that crisis of confidence can ratchet into a bad economy.
Just a fantastic lineup of guests yesterday for a special coverage on Credit Suisse and UBS. UBS taking over Credit Suisse for $3 billion. Mohamed Al-Arian, and on Twitter in the last 24 hours, a 167-year-old institution. He said Switzerland's second largest bank, a bank that opened its doors for business in 1856 and was one of the 30 systemically important banks around the world, will no longer exist as a standalone entity. Lisa, I think we have to step back and just take in the gravity of the moment. 167 years old. And here we are, Credit Suisse, essentially no more once all is said and done.
And when you take a step back even further, Switzerland, known for its banking industry, its banking complex, for a safe haven for capital from all over the world, now a one-bank town when it comes to systemically important major global banks. What are the ramifications of that? What does that mean? What happens in this integration, especially as UBS is now saying that Credit Suisse is still considered a competitor? I mean, really, we don't understand the process yet.
That's tough to get your head around,
right?
Exactly. Super tough. I think that's one way of motivating your employees or something like that.
To do
after
what?
the weekend. I don't know, not to be distracted by what's happened over the last week. Tremendously difficult to do.
Talking about employees in this bigger picture, how do you then communicate to everybody to come in every day and work their hardest in this morass of uncertainty that we continue to see develop in real time?
UBS down about 4% in Swiss trading. That's a recovery from where we were, down about 15, 16% a little bit earlier. I mentioned a call from Goldman. Jan Hatzius at Goldman Sachs. They now expect a pause at the March meeting. Their line because, quote, of stress in the banking system. Neil Dutter of Renmark just wrote in. He said the following: normally I'm not one to think about the Fed knows something that the market does not. If all we are doing is talking about economic data, I don't think the Fed has much of an edge at all. But given the specific set of issues we are dealing with around the banking system, this period is unusual. The Fed might actually know something we don't, which is why the signalling on Wednesday, Lisa, becomes that more complex.
Given the fact that the economic data does not justify a pause in any way, shape, or form, right? I mean, to that point, if they pause, it's not because of economic data, and they do have intelligence when it comes to the banking complex. So I think it's a good point. How do you deal with that, given where their knowledge is and where it isn't and what their data dependency actually is?
Let's get to our next guest. Joining us now, I'm pleased to say, Mayra Rodriguez Valladares, Managing Principal at MRV Associates. Mayra, thank you for being on the programme with us. Last weekend it was Signature, it was SVB. This weekend it was Credit Suisse. What are you expecting next weekend?
Right. That's really the question. I'm afraid that the regional banks in the U.S., of course, are still very, very sensitive to this crisis in confidence, frankly. But the demise of Credit Suisse is very, very different. And unfortunately, I heard some Swiss regulators and government officials blaming the U.S. banking chaos for the Credit Suisse demise. And this one cannot be pinned on the American banking sector. Unfortunately, kleptocrats and crooks have long been banking at Credit Suisse. It has decades-long unfortunately, history of many, many scandals. So if anything, I would really be worried about those really big banks that have weak operational risk. That's what we really need to be looking at.
We just had Bill Dudley, the former president of the New York Federal Reserve, and he was talking about how the one difference now, or one of the main differences now from 20 years ago, is that big banks don't want to acquire other banks so quickly. The litigation risks, the regulatory risks that accompany that are significant and opaque. What do you make of that in terms of how many provisions had to be put around the UBS acquisition of Credit Suisse and what that means for distress that we're seeing in certain pockets in the U.S.?
He's actually right, because the big banks have a lot of interconnections. There's just a tremendous amount of opacity that investors don't know. And I think that that's what we really should be focusing in the coming days, because right now everybody's trying to go through all the fine print of the memorandum, of the UBS memorandum of the takeover of Credit Suisse. But imagine all the opaqueness in the banks, especially in Credit Suisse. There's a lot of duplication. There's going to be, unfortunately, thousands of people who will be fired all over the globe because, of course, UBS will get a say as to who gets to say. You have shared facilities in terms of liquidity. You also have a lot of systems at both banks, many which are legacy systems. And so UBS is going to have to be combing through this all very, very carefully. Are there hidden liabilities at Credit Suisse that UBS hasn't had a chance to find out? There is no way that they were able to do all this level of in-depth due diligence to be able to do this deal. And so that's really what UBS and any big bank would be worried about in terms of trying to buy out another one.
There are two issues here. There are a lot of issues here, but there's what's going on with Credit Suisse and UBS, and there's what's going on over in the U.S. and some of the regional banks. The interlinkage, perhaps, is a confidence story, but the stories are separate in what is going on and why. And I want to just go to the U.S. story for a second, Myra, and this question of supervision of the Federal Reserve and the role of people to identify problems and adequately prevent against them spiraling out of control. What is your concern level in the inability to do that with Silicon Valley Bank and some of the others that have drawn scrutiny recently?
Yes, I'm glad you said the word supervision, because that's really, we need more supervision, not necessarily regulation. However, having said that, if big banks were required to be called systemically important, which is exactly what the Trump law deregulated, then those banks, the size of Silicon Valley, would actually be disclosing more about their liquidity, the composition of their deposits. And in the U.S., we have a very complex regulatory and supervisory framework. You have the state regulator. So state regulators often do not have the money. They don't have the resources, and they're the ones that are right there on the ground. So the state regulators are the ones that have to be empowered, and the banks should be required to disclose more about their liquidity, their capital, their other kinds of risks, such as leverage, the concentration. If investors had that information more often than just once a quarter, they would be able to discipline the banks. You cannot count on regulators or rating agencies to discipline the banks. But the banks are opaque, and they should really be disclosing a lot more about their concentration and liquidity risks.
Myra, bank failures, as you know, go back centuries. And I wonder if our biggest problem right now is the fact that banks fail, or the fact that seemingly we can't tolerate failure anymore.
That's exactly it. You have to let banks fail. The problem, of course, is that the people who are going to get hurt are the junior level employees, the ones that aren't getting the big bonuses, all the restaurants and hotels anywhere that had any business with those banks are the ones that get hurt. And we're no longer really a capitalist society. We are constantly letting these bank executives socialize the losses, and that's the problem. They should be allowed to fail. There should be clawbacks for bonuses, and you have to discipline rogue professionals at these banks. Otherwise, we're constantly doing this, and it's always the taxpayers that are bailing out the banks, I should say. And it's a problem for all the different kinds of central banks. The Fed now is probably not going to be able to raise rates, but it's not just because of what's going on in the U.S. I mean, do you think that Switzerland right now could raise rates, or the European Central Bank? We have global inflation, but now come all of these problem banks. And so it is really going to be quite a challenge for all of these different central banks, as well, of course, as the bank regulators globally. This is not just an American problem.
Myra, let's catch up soon. Appreciate your time this morning. Thank you. Myra Rodriguez Valladares there of MRV Associates. Not really a capitalist society anymore. It's quite a line, isn't it?
You get a prize. You get a prize. Everybody gets a consolation prize. Is that basically the implication that banks are not going to be allowed to fail? Because we did see Silicon Valley declare bankruptcy, and it is going to be broken up. But at what point can you ensure that there is a penalty for not taking the right risk prevention measurements? I mean, that's really what happened with Silicon Valley Bank in particular.
Politics happen too. Let's be clear about that. You know, politicians understand that there is some fallout to letting things fail. They know how this plays, which is why they're so keen to say this wasn't a bailout, it's not a bailout, it's not a bailout. And of course we all know, I mean, how can the Swiss come out and say this is not a bailout and offer at the same time a government guarantee? How does that work?
How do you game out, though, what's going to generate more losses for the taxpayer? If you want to go there, is it going to be creating a backstop to a bank, or is it going to be assuming the losses from whatever panic or whatever whatever deterioration in credit ensues from that?
Equity futures right now down about 0.1% on the S&P. No drama there. UBS at the moment down, let's call it 5% on UBS. First Republic right now down about 21% in the pre-market. Matt Brill of Invesco up next.
That a swift and stabilizing solution was absolutely necessary. And this solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a weekend in Switzerland. Another cliff edge deal to close out a week. This time it's Credit Suisse taken out by UBS for $3 billion. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures right now on the S&P totally unchanged. First Republic's down about 20%. Lisa, UBS is down about 5%.
Which is retracing some of the losses from earlier this morning. The unknowns really percolating through the uncertainty that we've been hearing from all of our guests throughout the morning, as well as the sense in markets of trying to game out whether we've restored confidence. Have we? Maybe not in First Republic, but maybe in some of the other regionals.
Sticking plaster or solution?
This is the question. Right now, it's not quite a solution yet. Can you really call this a solution when we have no sense and there's still people raising questions? I think we're going to hear from Fed Chair Jay Powell on Wednesday. Was this enough to put them on pause after just a week ago people were calling for 50 basis point rate hike?
I've got a rule. If you have to say idiosyncratic on 3 different issues, you've got one big problem.
That's a journalism rule. Basically, 3 examples makes a trend.
You know, come on.
I think that you're right in the sense that that's what everyone's looking for. And you're seeing that flight in real time. That said, at what point does this cause some kind of contraction in the credit impulse? And I think that this is really a question that we've rolled with, that basically this would lead to a tightening in credit conditions, particularly at regional banks. And yet we heard there from Gerard Cassidy of RBC earlier this morning. He's not seeing deposit flows, and we are seeing ongoing credit creation given the strength in the economy that we've been talking about for the past couple of months.
If you are just tuning in, we're already getting some calls from Wall Street economists looking ahead to Chairman Powell on Wednesday, and those calls are changing. This from Jan Hatzius at Goldman. We expect the FOMC to pause at its March meeting this week because of stress in the banking system. Now, pause. Pause to some people means that's the end. Pause to some other people means, well, that's the end for now, and then we restart hiking later on in the year. What does pause mean to you if we get one on Wednesday?
To me, it means the end of the cycle.
Certainly the market reflects that view.
That's what I would say. Because at this point, how can they say the turmoil has been enough for us to stop hiking rates, for us to shift our focus from the economic data that has come in hotter than expected on several occasions, numerous consecutive readings, and say this is a change in circumstances where something broke? If they say that, how can they then go back and say, no, nothing broke, we're all good? I mean, really, this is the conundrum that they're facing. But the market is pricing in 100 basis points, more than 100 basis points of rate cuts through January of next year.
Equity futures right now on the S&P, totally unchanged. Let's give you a flavour, a snapshot of the price action about 90 minutes away from the opening bell. Equity's not doing much. The bond market's doing something. We've got a rally again. Yields are lower by 6 basis points, 336.90, 337. Ish on a 10-year. On a 2-year, we're down by about 10 basis points to 374. The 2's10 spread now is only negative 36 basis points, and a few weeks ago it was something like negative 110. Was that after ADP? Do you remember that? It was negative about 110.
Yeah.
Huge turnaround, delivered really by what's happened at the front end of the curve.
Given the fact that people are ratcheting back their expectations for rate hikes, and you're seeing the long end of the curve, also yields come in, rally pretty steeply, but really it is the short end. We have seen a complete repricing of Fed rate hikes.
I think regulators worldwide just doing copy and paste from other people's speeches. This comes from the UK, the spokesperson for the government. We believe the UK has a robust banking system. Have we heard that from the US? Yes. From the
Australia?
Europeans? Yeah. From Switzerland? I think we heard that yesterday, didn't we?
Yeah, and even Australia. I mean, it's sort of the Australian monetary policy that came out, and they were like, our banking system is strong. This is sort of the cut and paste of central bankers.
They're kind of damned if they do and damned if they don't, right? If they don't say it, then you're like, why won't they say it? Why won't they say it? Maybe they don't.
Press paste.
Bloomberg's Francine Lacqua has done a phenomenal job of pushing this story forward over the last week. She joins us now from Zurich. Francine, does Switzerland now have a robust banking system?
Well, though, at pains at saying that they have a robust banking system, I did actually speak to a couple of people on the ground just 3-4 days ago saying that the Swiss regulators were a little bit slow to the game. They took issue with the fact that Emmanuel Macron, they took issue with the fact that, for example, in France, regulators, as soon as something happened with Credit Suisse, as soon as Wednesday and Thursday, came in and saying, guys, we've got this. So we did see the story developing very, very quickly in the last 2 to 3 days, but there is still a nagging feeling that maybe they could have placated it very quickly. John, the state of play is, look, there's now a lot of chatter on whether they should have done something differently with the AT1s, not wipe them out, maybe convert them into equity, and then taken a haircut on that. But this is where we are right now. The system is what it is. We had assurance from the chairman of UBS that he will go ahead with the deal. That, remember, was in question less than 24 hours ago if the CDS blew up. And so we'll then see what they do with the investment bank, with the Swiss Universal Bank, and we'll see how markets react to the rest of the European banking sector.
Francine, you're in Zurich there, and I'm wondering about the psychology of this tie-up, given the fact that Switzerland is known for its banking complex, and now effectively it is a one-bank town with UBS, the dominant global bank.
Yeah, the psychology is one of shock. I mean, even if you spoke to the people on the press conference yesterday, it's one of shock. They can't really believe that this unraveled so quickly. Remember, a week ago, we were talking about Credit Suisse that had a lot of problems, but that was still sound. It was a bank that was well capitalized. So they cobbled together this deal, maybe giving, Credit Suisse for too much of a cheap price away. But the reality is that UBS didn't really have time to do any due diligence properly. So they've tried to backstop, get as many guarantees as they can, even with the AT1 that they use for capital, to make sure that if there's anything ugly that they need to unwind in parts of Credit Suisse, they will have enough capital to do that. I mean, the question is, you're right, one of regulatory concern. If you have a massive Swiss bank, does the regulator go and give its blessing? We tried to speak to the FINMA chief executive. He said, look, that's probably the case. But what I suspect is that they'll absorb it and then break bits off, because that, frankly, is the only thing that makes sense going forward. So they don't keep everything. They take it, look at it, job losses, job cuts, and then you see what else you can spin off.
Hey, Francine, wonderful to catch up once again. Francine Lacqua there from Zurich on the latest with Credit Suisse and UBS. UBS is lower by about 5.5%. in Swiss trading, well off session lows. We talked about it in the last hour. Here's an institution, opens its doors in 1856. The test of time, goes through all of it, 2 world wars, still standing, and this is it. This is it.
There was a lot that built up to it. Let's be honest, right? So this has been in the works, right? This has been a tumultuous period with a lot of scandal and issues that really emerged through all of this. That said, was there a trigger in Silicon Valley Bank, a mid-sized bank in the United States, that led to this, as a lot of Swiss regulators were basically saying?
Swiss officials in that news conference, one by one,
yeah,
all basically saying that it was about what happened in the US. You don't buy that. I'm not sure many people do.
It raises a question of what does systemically important mean if a mid-sized regional bank could cause the demise of a Swiss behemoth.
Matt Brill joins us now, head of North America Investment Grade Credit at Invesco. Matt, the key there, investment grade. Some of these banks we're discussing a few weeks ago were IG. Make sense of that for us all.
Hey, good morning, Jonathan. Yeah, it's almost unimaginable what's occurred in the last 6 days. You think about banks in general, they're founded on confidence, and when confidence just evaporated, so did their ratings, and so did the bank. And that's essentially what happened in 2 different places or 3 different places. And now everybody's questioning where it goes from here. I think in terms of where you should be trading, because it's hard to analyze this right now. You got to be getting paid more to own these banks, because a traditional industrial can't default in 2 days. It can't default in 48 hours, even unless there's fraud, which makes this just a very different situation in the bank space. And that's why nobody has any confidence in owning it right now. And the credit spreads continue to sell off. And it's certainly a challenge to navigate. And this could have been analyzed, but when confidence goes away, it makes it all the more difficult.
So, Matt, at this point, is it really holding a falling knife? Is this basically liquidate positions, try to understand the risk before diving back in?
I think that's what most people are doing. Certainly, yes. I mean, I look at risk managers; they're telling you to own less than what you owned yesterday. That's the number one mandate. Whatever you own today needs to be less than it was yesterday. I think you've got quarter end coming up, which is clearly going to be some window dressing ahead of that. I think the banking system is going to get through this. I actually think, the solutions that have been proposed and brought out, I think are going to work. Everybody just needs to calm down, which is hard to get people to calm down. When somebody tells you calm down, you never calm down. But we got to get through the next week. And at the end of the day, these are sound financial institutions. But if there's no confidence, then there's no ability to have a foundation there. And I think that's just the problem. Is we just got to keep talking this up. And as you stated, everybody's going to tell you everybody's fine. And that will eventually get cooler heads to prevail. But it's just a very, very volatile period of time. And until we get through that, everyone's going to want to unless.
Matt, you said the solutions they've proposed. What are the solutions they've proposed that you think are really going to resolve this issue?
Well, I think that the bank facility window was a great one in terms of not having to crystallize the losses. It's essentially what took down SVB. All these treasuries, which were trading at a huge discount, now they've come back quite a bit with this rate rally. If you don't have to crystallize that loss, I think that's huge. I think that can, we don't have an asset quality problem. We have a liquidity problem. But as long as this persists, it eventually create an asset quality problem. So the Fed is giving up as many liquidity lines as they possibly can to make sure that there aren't more dominoes to fall. And I think that the liquidity they're pumping in the system should work. It should restore confidence. But again, we just need a few more days of not having the next domino to be in the news, which would certainly help.
Matt, you said something earlier on in the conversation to Lisa that stood out for me. The way we assess the risk around financials relative to all other industry groups, because banks can fail so quickly, so fast, just like that in a couple of days, seemingly. Matt, do you see that as a permanent shift or something that's resolved in time, weeks, months, quarters?
So you saw after the financial crisis, bank spreads traded well back of industrials for roughly 13 years. And then they finally kind of got back in line, call it 2021, somewhere around there. So it's going to take a long time. I think absolutely regional banks are going to trade cheaper. You're going to see the big six will trade better, but I still think those have to probably trade cheap to industrials as well. So this is not going to be fixed overnight, even if the Fed continues to talk this back up.
Matt, they're playing the music, which means I've got to go. So you've got to do one-word answers, 25 or 0 on Wednesday.
25.
25. Matt Britt of Invesco. Thank you, sir. From New York City, futures, negative 0.1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least two parts. The rout in oil prices resumed today. West Texas Intermediate fell below $65 a barrel at one point, while Brent dropped below $71 after last week's 12% decline. Concerns about a global banking crisis is hurting demand for commodities and other risk assets. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. Now, a 3-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending that war. Now, the plan has been dismissed by most Western governments. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
One of the problems of pausing is people are going to say, gee, why is the Fed pausing? Things must be worse in the banking system than we think. I think this is a very different situation than the great financial crisis in the sense that the banks, this is a question of confidence in banks due to uninsured deposits and mark-to-market losses. It's not about the economy that's collapsing.
This is a difficult moment for Chairman Powell and the FOMC. That was Bill Dudley, the former New York Fed president, catching up with Lisa and I in the last hour or so. What do? When they understand there is a signal that you send when you do something, and also a signal you send when you choose not to.
You know, we were saying this before the ECB meeting last week, and we said, what do they want to do? We don't want to be Christine Lagarde. They clearly were debating it. They came out with a 50 basis point rate hike. And actually, it probably was the right thing based on market response that day. Whether it was this week, we'll have to see. But, my point is, it's hard to know what the market response will be to the decision, let alone what the decision is.
Well, everyone's pretty split because no one really has any idea.
Correct.
So Goldman and Jan Hatzius have come out and said this morning we expect the FOMC to pause at its March meeting this week because of stress in the banking system. That's Goldman. They're at pause. Matt Brill, Invesco, 5 minutes ago. Same data in front of us all is basically saying no, they're going to go 25.
So if financial advisors are therapists to their clients, how are they giving them therapy when essentially they're saying, you're asking me, I have no clue? This is really the sort of conundrum that people have. Where do you get a guide if this is really a moment that we haven't seen before?
I've always said that FAs are meant to be market therapists and they should do courses in psychology.
I think that they do.
Some of them do.
Yeah.
The smart ones do. Equity futures right now, I'm not saying all the other ones aren't. Anyway, on the S&P right now, down 1/10%. In the bond market, yields in 3 or 4 basis points, 339 on a 10-year. On a 2-year yield, we're down another 7 basis points to 377. We're taking out more hikes. We're pricing in more cuts. It's not just the US, it's Europe, it's the UK. Take your pick. The BOJ just never joined the party, and maybe there won't be one over in Japan after the events of the last few weeks. But again, who knows? Michael Arrighetti joins us now, co-founder and CEO at Eris Management. Michael, wonderful to catch up with you, sir. I think we need to talk about speed, just how quickly this is moving. What do you make of it all?
Yeah, I think you hit on a big challenge in today's market environment relative to past cycles. I think with the speed with which money can move through the system, the speed with which information is coming at us, it's getting harder and harder to distill the signal through the noise.
So we're talking with you, Michael, at a time when people are wondering who will take over some of the institutions that are seeing some distress, who will come to the rescue. And we were talking with Bill Dudley about how big banks learned their lesson during the financial crisis and are concerned about litigation risks. From your vantage point, given that Ares oversees $352 billion of assets, including more than $200 billion of credit, what's your view on that? Where is your role?
It's interesting. I think the private credit markets have been playing a little bit of a stabilizing role here over the last couple of weeks and months as liquidity in the traded markets is not what it used to be. I think folks like Ares are coming in and really providing liquidity in certain markets where liquidity has gotten thin. One thing I think about now as one of the larger private credit managers is we don't know exactly how this all will unfold, but I can tell you one thing. We will see more regulation of banks, both mid-sized and large. We will likely see a change to bank capital regulatory framework here in the U.S. and abroad. And that capital contraction will make it ever more important that private credit plays a role in funding the real economy.
So at what point, and I want to go to the funding the real economy in a second, but just in terms of the here and now, is Ares going in and picking up bank bonds? Is Ares coming in and discussing how to finance banks that perhaps are threatened with deposit outflows?
I mean, I remind you, Lisa, we play strictly in the private market. So we do have certain pockets of capital within our opportunistic credit and distressed businesses that will dabble in the public market opportunity that gets created here. But the opportunity set for Ares and those that look like us really is to come in and be a liquidity provider to the small companies that may be challenged to get liquidity from mid-sized and regional banks. And it could be as a real good counterparty to the banks on reg cap trades that they try to revisit the liquidity on their own balance sheet.
You talked about the broader capital sphere that we're watching and this concern about whether commercial real estate operators as well as individuals and small businesses can get the loans that regional banks used to provide to them. Michael, private credit might step in, but how much more expensive will it be to get it from a private equity company or a private debt firm than from a regional bank?
Look, I think historically the private credit markets have been more expensive. That's largely because they tend to provide a level of creativity or innovation or frankly more leverage or structural flexibility than a bank solution could. So I think the market is pretty well attuned to a higher cost of capital. I think you raise an important point though here is what we're dealing with now is liquidity and duration, not credit. We're already seeing the impact that cost of capital is having as rates are moving up so quickly. I think we first need to get to a point where the equity valuation environment adjusts to the new realities so that people can actually afford a higher cost of capital if that's where this takes us.
Michael, one issue that's come up repeatedly over the last week is this idea that ultimately now we'll end up with tighter lending standards, tighter financial conditions. I think a lot of people are lining up to give us the stats about how dependent certain parts of this economy are on the financing from small and medium-sized banks. We're thinking about real estate a whole lot more. Michael, how are you thinking about the ripples from what's developed in the last couple of weeks from these banks and what regionals are going through and what it means for an asset class that I imagine you're exposed to?
Look, I think it could be very challenging. I think that the Fed is doing everything it's supposed to do to step in and provide confidence. I was pleased to see the larger banks in the market step in to provide support to First Republic. I think at the end of the day, again, this is duration, liquidity, and confidence, not credit. So I would hope that folks calm down, again, see the signal through the noise and get back to lending. But it is a real risk. Obviously, to the extent that people continue to lose confidence, capital leaves that part of the banking sector, and it is going to make it harder for people to access capital for sure.
It feels like a year ago, but last week, Larry Fink of BlackRock said that there are a number of shoes that are going to drop. First, it was Silicon Valley Bank. Then it was other smaller and medium-sized banks. And next, it would be the private credit and private equity and venture capital markets that wouldn't get that credit. Do you agree with that?
I think one thing that is probably most misunderstood about the private markets, which is why, it's always been this view that they're the canary in the coal mine, and yet every time we have a crisis or a mini crisis, private markets tend to emerge fairly unscathed. And I think the big difference that folks don't really appreciate is, one, most private credit assets are held unlevered. To the extent they're levered, they're modestly leveraged with match duration and match funding. Juxtapose that with a bank that is 10 to 15 times levered, and you get obviously a much different outcome in markets like this. Similarly, on the equity side, they are operating out of funds with 10 to 12-year life cycles. And so most private owners of assets that are institutionally backed are neither forced sellers or forced buyers in any market, and that provides a level of stability that I think people may underappreciate when we go through markets like the one we're in right now.
That's a constructive point. Michael, got to leave it there. It's wonderful to hear your thoughts. Thank you. Michael Arougheti there of Ares Management. What do you make of that, Lisa?
A lot of people have been talking about this, that basically if you don't have to sell, they can ride through without the constant real-time pricing. I might argue it depends on what sectors you're exposed to, because if you're exposed to certain companies in Silicon Valley, it might happen perhaps a little bit quicker than the maturity that you have. So I think that probably people are parsing through exactly who the companies are. But this is a point that's been made. The liquidity mismatch isn't there to the same degree.
The speed at which this has moved.
Exactly.
This has moved so quickly. 2 weeks ago, Chairman Powell sitting there. Not even 2 weeks ago. No. Chairman Powell opening the door to go 50. People are lining up and saying, how low's the bar? Now we're talking about how high's the bar to go 25.
Is it Twitter's fault?
It's Twitter's fault.
Is that the reason why?
According to certain officials around
Twitter-fueled
the Credit Suisse story. OK, next hour, Bloomberg TV, Mona Mahajan, Edward Jones, Gagi Chowdhury, BlackRock, David George of Baird, Daryl Cronk of Wells Fargo. Looking forward to that. And Lisa's going to catch up with Leon Cooperman in the next 30 minutes.
Welcome back. This is Bloomberg Surveillance. After a morning of turmoil trying to parse through what it meant for UBS to agree to take over Credit Suisse in a deal very much facilitated by Swiss authorities, we are seeing the market reaction with UBS shares sharply lower. Initially, they have retraced some of that in the markets. A churn in the U.S., basically unchanged in equity futures. UBS has retraced a lot of it to only 4.4% in terms of a decline. In the bond space, the move is much more clear. That is, yields lower, price up, both in the U.S., both in Europe. We're looking at two-year yields now 3.8%, off earlier lows, but still down from more than 5%, nearly 5.1% at the high earlier this month on March 8th. Over in Europe, you're seeing that two-year yield in Germany down to 2.28% from a high also on March 8th of 3.3%, just a complete retracing. Euro strength, what does it mean for Europe to be raising rates at a time when the U.S. might be on pause? That is the question facing Jerome Powell on Wednesday. That was the question facing Christine Lagarde last week. She speaks again. Maria Tadeo of Bloomberg in Brussels right now. Maria, what are we expecting to hear from Christine Lagarde at a time when she made her move? She said that they have unique tools to deal with any kind of systemic issues in the financial system. Will she pull that back a little in terms of reasserting future rate hikes in the ECB?
Well, look, what a situation she finds herself in, because when you look back to last Thursday, and obviously she went in for those 50 basis points and then made it clear that the European Central Bank does not see a trade-off between price stability and financial stability. That was a press conference, and I must say a number of sources told me was one of her best press conferences to date. That was a tick. That was well done, Madame Lagarde. Now she finds herself 4 days later here in Brussels, now having to instill confidence in a market where obviously the jitters continue, and having to once again reassure not just investors but essentially now general population. I mean, this is a huge talker in Europe about the health of the European banking system. So again, what a communications exercise from Madame Lagarde. The one thing that I would point though is beyond that statement from the ECB yesterday, this session today, this was already on the agenda. We were expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks. These will be the questions the lawmakers will put to her, and of course that's the focus point for us too.
Maria, when we talk about confidence, I have to just drill into this one instrument that a lot of people haven't heard of yet, the contingent capital bonds, the AT1 market, the $275 billion of debt, now called into question after Credit Suisse's debt essentially was written down by Swiss authorities. We're hearing some pushback from European authorities saying, no, actually, equity has to get wiped out before these instruments. Is there a bit of a tiff emerging between European regulators and Swiss regulators that acted alone?
Yeah, and I think you read it quite well. And if you look at the statement last night, and to me this is very telling, and I wonder what you think of it. If you look at the statement yesterday from the European Central Bank, and you read between the lines, essentially what they said was thank you to Switzerland and UBS for essentially stabilizing the situation, alongside repeating the European banks are solid, they're well capitalized, and there's liquidity. If you look at the statement from the regulator today, it's a different note. Essentially they say, and I want to read it just to be very accurate here, it says, obviously the common equity instruments are the first ones to absorb losses. Only then after you would look at AT1s. And then this final line, which to me is crucial here from the European regulator, again, goes back to your point of whether or not there's a subtle criticism here. It says additional tier 1 is and will remain an important component of the capital structure of European banks. I think that tells you a lot in terms of just how much perhaps the sentiment has changed overnight to the morning, when you actually now have the time to figure out the details of a deal like this.
And let's see, as market participants parse through it as well, because you are seeing those contingent capital bonds, those AT1 notes, severely repriced lower this morning. Maria Tadeo, thank you so much, and we will be catching up with you throughout the morning. I do want to bring you some news. The FDIC just releasing this, extending the bid window for Silicon Valley Bridge Bank. This question of whether there are buyers, we've asked this. Why did nobody show up, or did anyone show up to the auction, the effort that the FDIC made to try to find some buyers? They say that now they have substantial interest from multiple parties. What that interest looks like, how that comes in, remains to be seen. The FDIC says bidders need more time to explore all options. So how much is this due diligence to understand all of the potential liabilities? We will bring anything to you as we parse through some of the documents and what they have so far. Tiffany Wilding has been studying this throughout the ups and downs of all of the rate hiking and the rate cutting expectations. She's North America economist at PIMCO. And Tiffany, you came out with this question of whether they hike or whether they don't hike is kind of not the issue anymore. It's when do they start cutting? Tiffany, from your vantage point, what is the answer?
Yeah, well, I think it's going to really depend on how quickly this situation escalates. You know, really the issue here is how tight are financial conditions. And clearly what this whole situation has revealed is that they're actually really quite tight. I think that there is a lot of question around that, because, that maybe the impact on the economy or the labor market was a bit slower than some had expected, but these things happen in a nonlinear fashion. And so I think what this situation revealed is that actually financial conditions are quite tight. And I think the question for central bankers will be, have they tightened so dramatically as a result of the bank stress, which is going to put pressure on lending? Have they tightened so much that that maybe now the Federal Reserve needs to think about interest rate cuts? Unfortunately, I don't think they're there yet because we're still discussing if they're going to do 25 or not. But certainly, if history is a guide, at least, when they do get to the top of a rate hiking cycle and they pause, usually the next move is down.
Tiffany, if credit conditions are so tight, why are we not seeing it in the data? Why is it not percolating through to a loss of momentum? Why am I getting letters from people saying you clearly haven't been out and seeing everybody eating out and flying around and doing things and getting jobs? So where's the disconnect?
Yeah, well, I think the issue here is that, again, like what's happening in the banking sector right now is a bit more of a leading indicator. We look at the actual data, that's kind of what has been happening. And again, as I said, these things kind of happen in a nonlinear way. In other words, the economy doesn't tend to just slow down, in a stable way, right? It kind of slows down and then at some point, it really starts to deteriorate. And obviously, that's kind of when we go into a recession. So I think we've sort of been suggesting that the recession probabilities are very high as a result of how fast central banks have moved over the last year in order to get inflation down. We still think that, if anything, the developments in the banks over the last couple of weeks have probably pulled forward those recession probabilities somewhat.
This is what Bob Michael over at JP Morgan Asset Management was saying as well. He thinks that this brings forward the potential recession. That said, what is the risk if the Fed pauses now, starts cutting rates as soon as June, which is what the market is currently playing around with here, and more aggressively cuts rates throughout the year? What are the risks of inflation perking back up again, that basically that momentum doesn't die out quickly enough as people start to buy homes and take out auto loans and do all the things that they can do with lower rates?
Well, so I think the issue here is that inflation is very elevated. If we were at, even 3% inflation, I certainly don't think the Fed would be hiking, if they do turn out to doing so this week. But the thing is when you have banking sector stress that tightens credit conditions, reduces banks' willingness to lend, you're going to have activity that's slowing down, and ultimately you're going to have inflation that's coming down. The issue, though, is that there are lags to these things. And inflation, even if we do go into a recession, over the next couple of quarters, say, it's going to take a little bit longer, even despite that, for inflation to be more clearly coming back to target. So, unfortunately, as a result of the high levels of inflation, the Federal Reserve and other central banks right now, the ECB, of course, as well, they're going to be kind of lagging in their response relative to what we've seen in the recent past. And I think the question there is, does that tighten financial conditions even more as investors get worried?
I'm a little concerned about the political implications here, and I've been raising this throughout the morning, and I'm not sure exactly how this plays out, so please help me, because I'm thinking about Silicon Valley Bank and the story in the New York Times, the stories in Bloomberg about how aware Fed regulators were about some of the issues there, the fact that there were oversights there, the fact that we don't know what other oversights there could be at other medium-sized banks that were highlighted to regulators that they're watching right now. What is the signal of not raising rates by 25 basis points if they do have a handle, as Neil Dutta pointed out, on what's going on in the financial system in a way that the rest of the market does not?
Well, I mean, that's true that the Federal Reserve has more information than market participants about banks and what's going on. And I think that the Fed basically has to weigh kind of two issues here. One is just the risk that, things deteriorate. They hike again. Things deteriorate quite a bit more within the banking sector, and that sort of in and of itself kind of destabilizes confidence, because one of the issues here obviously is higher interest rates. I mean, that's what created some of the unrealized losses losses on these banks. There's a question around how much can banks raise their deposit rates to stem some of the capital or the deposit outflows from those institutions. So raising rates certainly is not going to help those types of things. So I think the Fed has to weigh that with the fact of kind of what you're talking about. What does it signal if they do pause? I actually think that if they did pause, Chair Powell could very easily sort of communicate in such a way that keeps confidence. He could suggest that, there's a lot of volatility in markets right now. We're just going to pause. Our outlook is still for additional rate hikes, contingent on this not getting worse. And so that would sort of suggest to markets, that, we don't think we're pausing. We don't want to, exacerbate the stress. But our outlook is still for hikes. That could potentially bridge the gap.
Just quickly, Tiffany, if the Fed does start cutting, where do they end up? What is the new normal for neutral?
I think that's still a very key question, and that's something, unfortunately, that we're not going to know, until after the fact. Right. I mean, even the models that people have devised to estimate neutral, they need to see the data, so we don't really even know, according to the models, where neutral would be until, kind of well after where we are right now. So I think that's still a key question. Ultimately, I think our view would still be that we're in this world of new neutral, so it's still pretty low.
Tiffany Wilding of PIMCO, thank you so much for taking the time. Coming up, we have a conversation with Leon Cooperman, Chairman and CEO of Omega Family Office, to parse through the role of private investors, the understanding of markets, and how quickly we have brought forward recession risk. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government-brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that the capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorse the actions taken by the Swiss authorities. First Republic is set to extend its record loss today. Shares of the bank are plunging in pre-market trading after S&P Global Markets cut its credit rating again. Last week, some of the biggest U.S. banks pledged $30 billion in cash for First Republic in an attempt to stem the turmoil. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. And Starbucks says Laxman Narasimha has assumed the role of chief executive officer 2 weeks earlier than planned. Narasimhan began working at the coffee giant in October and spent the last few months getting to know operations at more than 30 stores and other facilities. He's replacing Starbucks founder Howard Schultz, who had been interim CEO since April. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
UBS's announcement of the acquisition of Credit Suisse is certainly going to should calm the fears of a global banking crisis. What I'll be watching this week is whether there are more pressures on the liquidity of mid-size and regional banks in the United States that would conceivably keep this, I'll call it a mini crisis, brewing for the next few days.
All eyes certainly are on the regional banks as well as UBS shares as people digest what happened over the weekend with UBS taking over Credit Suisse in basically a shotgun marriage operated by the Swiss authorities. That was Dennis Lockhart, former Atlanta Fed president. This is Bloomberg Surveillance. John Farrow is off preparing for his next property. Tom Keene is on a well-deserved week off. And we are taking a look at markets that are trying to find direction after all of the events, given what the concerns are about the banking industry and given that people are trying to parse parse through a Fed response, which is likely less in terms of hikes and more in terms of cuts. We are seeing the S&P up about 0.2% ahead of the open. Euro strength, this is interesting after Christine Lagarde came out and raised rates by 50 basis points. Will Jay Powell also raise rates on Wednesday or not? We see that 10-year yield coming in just a touch, but really the action is in the 2-year with yields decidedly lower, down more than a percentage point from the high on March 8th. Just shocking to see 3.8% on that 2-year yield in the U.S. after it had been as high as 5.1% earlier just this month. And lower on crude, and it's kind of interesting to see this as people expect to see some sort of deterioration in the overall economy. UBS shares clawing back some of the earlier losses. At one point were lower by more than 10%. Now down just fractionally, down about 0.9%, really clawing back almost to zero, almost to neutral, almost to no gains, no losses, as people think maybe they got a better deal than they otherwise thought because of the backstop from the Swiss government, because of the losses being written into the AT1 bonds. And given the fact that they're getting a U.S. business, assets under management, and the crown jewel for such a discount. Joining us now, I want to get straight to this guest because he has been calling about the potential for a recession, about irresponsible Federal Reserve policies, about how to conduct market operations in a market that has gotten a little bit beyond what we are used to thinking about with a capitalist society. Leon Cooperman, Chairman and CEO of Omega Family Office, joining us now. And Leon, I just want to first start with, what's your impression of everything that we've seen over the past, I would say, week, last weekend with what happened with Silicon Valley Bank, and just now with UBS taking over Credit Suisse?
I think, without being overly simplistic, to me it's kind of like textbook. We've degenerated into a system of leadership at a crisis. We have a self-induced crisis by irresponsible fiscal monetary policy the last decade. I did not forecast the Silicon Bank issue, but I did have a view that we were heading to a crisis of some kind, and we're seeing it. And we're getting a predictable response by government. And so I think it's sad, what's going on in the country, but what they're doing is what is necessary to be done. And they have to preserve the system. So I'm assuming that the Fed goes 25 bips on Wednesday, 25 and done. They can accept a higher level of inflation and than they would like to accept because of the stress in the financial system. They have to stabilize the Treasury market. The volatility of bonds is so great that that's destabilizing the equities.
Well, Leon, I want to pick up on that because we've been talking about that. We've seen unbelievable fluctuations in the basic, most liquid instruments in the world, right? Treasuries. What's the read-through effect of just even that volatility on other risk assets? And how much further does it have to take that out in terms of the volatility pressuring equity valuations?
That's not my area of expertise, but I would say that this is a response to the debt buildup in the country. In 2017, we had $20 trillion of national debt. And today, we're knocking the door of $32 trillion 5 years later, 5 or 6 years later. It's just a growth rate in debt far in excess of the growth rate of the economy, which is going to create issues. Who's the buyer? The banks are not the buyer of bonds anymore. So you're relying upon the kindness of strangers, and they're probably not imbued with our financial policy. When they look at the politics of the country, it's also very depressing. We have a country that I think is largely centrist in nature. It's been taken over by two political parties with the radicals, radical right, radical left, ruling the day. We don't need this.
Well, Leon, we're dealing with a situation where the political overlay is raising questions about the debt ceiling debate, and we can get into that, and people are trying to figure out what that means economically and for the market. Your expertise is in the S&P, in the market, and market calls, and you've been warning about a recession for a long time. You've been saying that this is a self-induced error of monetary policy and woes, and I'm curious, first of all, whether you're getting more optimistic about returns because of the declines that we're seeing and because of perhaps people waking up to the reality of the potential for recession as you've been saying it.
Well, my view has been as follows. I tell the story about the Pharaoh. I told this almost a year ago on TV. The Pharaoh, had a dream. The dream was interpreted by Joseph. It was in the Bible. His dream was we're heading for 7 lean years after 7 fat years. And that is my view. I think the 4,800 on the S&P will be a high that will stand for quite some time. And then I kind of analogize that to my own career. I got my MBA from Columbia Business School on January 31st of 1967. Had a 6-month-old child at the time. Now he's a healthy 56-year-old. I had no money in the bank. Had a student loan to repay. They were not forgiving student loans. And I couldn't afford a vacation. I went to work the very next day. I joined Goldman Sachs for my 25-year career on February 1st of 67. The Dow was 1,000. In 1982 it was 1,000. And so I made my money picking stocks. I'm not selling anything to anybody because I'm a retired money manager and I'm turning 80 years old in a few weeks. But I would say that I think we're in a stock picker's environment. I expect the returns in the S&P to be very pedestrian. I think what's going on in the world is negative for price earnings ratios. And I want to make this point. If the government is looked upon to moderate the downside risk, the government has every right to moderate the upside return. Okay? This CHIPS Act, I think Intel sits at a balance sheet of $50 billion. They don't need the government to build plants for them. They can do it themselves. I'm in favor of private sector solutions. And the extent that the political system is getting corrupted, that's negative for capitalism long term.
So, Leon, from your perspective, you have made your career in picking single stocks. Where are you putting your money now, given that you still are investing, if perhaps for yourself and for others? Where do you go?
I'm like a one-off kind of guy. I'm looking at a couple of these mortgage REITs that are yielding 14 to 16%, selling a discount to book value, where they're buying back their own stock whenever it's, in their view, cheap. But, those are one-off. My biggest exposure has been energy, and that's cost me some money this year. I'm generally of the view that world travel will come back, which will be a plus for energy demand. China coming out of lockdown will be a plus for energy demand. We're going to no longer deplete the Strategic Petroleum Reserve. We have to rebuild it. And we're not replacing reserves to the extent that we should be in terms of where we're producing.
Yeah.
So I have a bunch of oil stocks in my portfolio that have current yields of 5 to 10%, production cost well below current prices.
Yeah.
They're largely debt-free, and they're positioned to buy back undervalued stock. So my favorite is Paramount Resources up in Canada, POU. They produce oil for $31 a barrel. They're growing production at 15%. The stock yields over 5%.
Yeah.
And they have no debt.
Leon, bumping up against the clock, 30 seconds. Do you agree with Elizabeth Warren that there should be insurance for deposits that's more than $250,000 and that banks should have to pay for that?
There's very little that Elizabeth Warren says that I agree with. But, I think we have to do whatever we have to do to stabilize the system, and we will do it. But I think I'm focused on the long-term implications of what they're doing. So I think that, yes, they should do whatever they got to do to stabilize the system. It's a damn shame that we have to do what we're doing, that we not should have been in this problem. Mr. Powell, the Fed head, said that the stock market wasn't overvalued. This is a few years ago because of where interest rates were. He never bothered telling people interest rates didn't belong where they were.
Leon Cooperman, we're going to have to leave it there. Thank you so much for joining us. Leon Cooperman of Omega Family Office. We really, really appreciate your time. Right now, you're seeing UBS shares, at least the ADRs, clawing back all losses in pre-market trading as people reassess this deal. Coming up on Bloomberg Television at 3:30 p.m., Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley, from New York on a day parsing through the uncertainty. This is Bloomberg.